tend to tell people is focus on the longer term. Focus on, I think the danger of the world we live in, the sort of Snapchat, TikTok, meme stock thing is dangerous. And what you want to say is this fundamentally a good business? Is it in a good sector? Is this a good piece of real estate where supply is limited, demand is favorable? And if you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
An exclusive conversation there with the Blackstone president and COO, John Gray. You can catch the full interview on the first episode of our new series, Bloomberg Wealth, with David Rubenstein, which debuts July the 6th on Bloomberg TV. Now, it's Friday. Let's look at what else we're watching today. Kaylee, what's on your mind?
I'm watching UMich consumer sentiment data at 10 a.m. Eastern time, Francine, specifically the inflation expectations metric within that, because last month that rose to the highest since 2013. So I'm interested to see if those expectations on price growth go even higher today, Matt.
Kaylee, I'm going to be watching the weather, and not literally the weather here locally, but globally, we have experienced drought conditions which have really hit grain production as a result, or at least partially as a result of that. You see food prices rising to the highest level in a decade as inventories shrink. So this is very important. I don't think enough people are talking about it. Francine?
Right. I'm watching the G7, so they seem to be combining their efforts, certainly to deal with Russia and China, but also to get more vaccinations to the developing world. That may be linked to new climate goals. And of course, it's UEFA Euro 2020. It starts tonight, and I wonder whether the G7 leaders will be watching that in Cornwall.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
inflation expectations are back. I think the Fed is going to need to recognize this risk, certainly over the next year.
The Federal Reserve, they take inflation very seriously. They think about the data.
Market, the bond market, is focused on this labor picture.
I would suspect the Fed is welcoming this relatively nuanced volatility.
We need to see whether these supply issues are indeed short-term, but if they are going to be persistent, then central banks probably will have to move.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, a Friday simulcast on Bloomberg Television, Bloomberg Radio. Matthew Miller in Berlin, in for John Farrow today. Lisa Abramowitz, obviously, as well. A most interesting day, yes, wrapped around the G7, wrapped around the equity markets that we saw yesterday. And Lisa, I want to go right to that interview yesterday, the first interview Deutsche Bank has done off their bombshell report. Peter Hooper on the time bomb of inflation of 2024. Lisa, that is what haunts this market in our study.
Haunts it maybe theoretically, but not when you look at the price action. And this is sort of the interesting aspect of markets right now. You've got that sort of ghost of potential inflation past coming back potentially either next year or the year after, with this expectation that incredible monetary stimulus in tandem with fiscal stimulus will lead to what we haven't seen for 30 years. But you pair that with the incredible Fed impulse, and you pair that with bond buying overseas, and you get a bond yield near 1.4% on the 10-year for the biggest weekly drop in yields going back a year, Tom.
Out front of the data check to 4 digits, 1.4384. Matt Miller, that's almost Germanic. That's a yield Christine Lagarde would know.
Well, German yields are going in the opposite direction. By the way, Tom, I thought it was interesting that the Bundesbank this morning put out its new forecast for the year. Growth is going to be back to pre-pandemic levels and then much higher next year. But inflation, although they have it at 2.6% this year, comes back down to 1.8 and then to 1.6 in the following couple of years. So even they think inflation may be transitory.
This is really interesting, folks. It sets us up on a Friday for weekend reading to really get started here into the Fed meeting next week. Lisa, I've got to look at the real yield. Absolutely extraordinary. I really came in this morning, folks, from the surveillance siesta, and I looked at a 10-year real yield of a negative 0.93%. Is it safe to say, Lisa, the 10-year real yield plunged yesterday?
It plunged yesterday. I'm wondering how much we can actually take away from this, because you have an increasing number of people saying it was a technical trade, that basically this is a massive short squeeze. And this is people getting squeezed out of those positions, will reset, and then yields will start to creep higher. That said, there is this expectation that the Federal Reserve will be able to stay on hold with their $120 billion of bond buying, with their zero-rate policy well into the future, even as we see inflation pick up. And that really explains why the actual yield you're getting is going more negative. Yeah. Negativer and negativer?
Oh, negativer. I like that. They're getting Chicago folks to come up with language like that. Matt Miller, what have you learned about G7?
Well, one thing I've learned about G7 is that the U.S. stands in a really different position from Europe. Charles Michel was on today with Guy Johnson saying, look, they have a great trade deal with China and they want to stick with it. He also said, look, they have a great pipeline with Russia and they want to keep that going. So some of the issues that the U.S. is very concerned about, Europe sees in a very different light.
Well, we've got Mario Draghi perhaps landing in Cornwall. We'll look at that here in a moment. Right now, I want to look at the data check here. We welcome all of you on radio and TV to green on the screen. Futures up 1, Dow futures up 47. The VIX under 16 speaks volumes of this bull market, 15.98. Let's review the bonds we've already touched on. A 144 in the 10-year yield. That is stunning, even for the people looking for lower yields. That is stunning. The 10-year yield, negative 0.93. I'm going to look at some dollar. I'm going to call it strength here over the last 24 hours. A euro 121.53. EM's just sort of there. Renminbi sort of there.
Really?
Brent crude sort of there. 72.63. Lisa, save me here with what we're doing today, because I'm waiting for Draghi to get off the plane.
I'm sort of there also. That is the Friday that we're at. There is a question when you talk about the bond yields, how much that's driving people to riskier assets, which will be a theme throughout the week next week, no doubt. Today, the G7 summit kicks off in Cornwall, England. I am looking for expectations of a discussion on wealth inequality, how to redistribute wealth. And this goes to the taxes, this idea of taxing corporations more and having a minimum global tax. It goes to distributing funds from these wealthy nations to poorer nations that have been harder hit by the pandemic. We're going to hear more on that today. 10 a.m., this to me is the data point potentially of the week. This is the U.S. University of Michigan Consumer Sentiment Survey for June. I'm not looking at the actual overall numbers. I'm looking at the 5 to 10 year inflation expectations. The last reading, we saw the highest level going back to 2011. How much higher will it get as people shrug off the Fed's input for inflation? They go to the grocery store, they buy a used car, they buy a new car, and they say, oh my gosh, this is serious inflation. And that's what we're seeing in these sentiment surveys. And arguably, inflation expectations among consumers is what will lead actual inflation. And then at 2:45 p.m., Janet Yellen is presiding over the Financial Stability Oversight Council meeting. This I'm interested because as you see that yield go lower, the real yield go more negative, that money is flowing into risk assets. Right. If you take a look at junk bond yields, they are now 1 basis point from the lowest on record. The question is, what is the financial stability risk on the longer term that's getting posed?
And quickly, Liz Ann Saunders out with the earnings yield back to 1980. That's what the real yield is doing in this odd market. We're going to go to Guy Johnson right now, and we do this with the Prime Minister of Italy, someone we know so familiar here at Bloomberg. Mario Draghi scheduled to leave his plane here in a moment. There he is, Mario Draghi. On radio, we're seeing Mr. Draghi with mask on, being greeted in Cornwall, and we greet with mask off Guy Johnson. Guy Johnson, Italy is one of the great triumphs that we see in G7 recovery. Explain right now what Draghi wants to get out of G7.
Well, Draghi is part of a triumvirate of European leaders that are going to be sort of coming here over the next few hours, Tom. They want to basically coalesce their authority to try and put Europe on a similar level to the United States. The authority that Joe Biden brings, they want to represent that same authority from Europe. So Draghi arriving now, we'll get Angela Merkel and then Emmanuel Macron coming over the next few hours. They will come here. They're going to have a setup meeting. They're going to get all on the same page. It's a coordination meeting, they're calling it, and then they're going to be there trying to represent the European Union, trying to give it the authority that they feel that it deserves, that maybe they feel that it is lacking at the moment. There is still a sense of wariness, Tom, about the United States. The administration may have changed. Boris Johnson described Joe Biden as a breath of fresh air yesterday, but there's certainly this feeling within Europe, within the European Union, of wariness about the new administration. Yes, the figurehead may have changed, but has the America First policy changed? How significant a difference are we going to see here?
Mr. Draghi is an amazing story, folks. Of course, Francine Lacroix and I with some quality time with him at Davos, among other locations. But this is, of course, without question at the G7, the most financially and economically astute member. Mr. Draghi from the Massachusetts Institute of Technology, truly world-class economics, and then linking that into policy as well. What is the policy goal, Guy Johnson, of this British G7 meeting?
The policy goal, I think, of this meeting is to, well, from Boris Johnson's point of view, is to put Boris Johnson and Brexit Britain on the stage. He wants to deliver a diplomatic coup to be able to really kind of give that whole sense of momentum. But beyond that, I think there is a strong feeling that what needs to come out of this is a number of things. First of all, we need to get the vaccine situation sorted out. There needs to be that humanitarian effort, which has a huge economic backdrop to it. And Lisa was just talking about the assistance that will be required to put many of these economies back on the right trajectory. But COVID and vaccines need to come first. The economy comes after that. Only can the economy come after the vaccine situation has been sorted out. So that's kind of job number one. And then there is just a sense of the need to put all of these countries, democratic countries, on the same stage and make sure that there is a single voice being spoken to authoritarian leaders like that we find in China and in Russia. Those are the objectives, Tom. But today, the agenda is going to be dominated by the economic recovery. They are going to focus on the economy this afternoon. That's where the man that we've just been looking at, as you say, Mario Draghi, I think is going to add a huge amount of weight to Europe's position. He comes with huge economic credibility, obviously, after his time at the ECB, now Prime Minister of Italy. So he will certainly add huge weight to that. Matt.
I got to say, I love those Range Rovers. When you look at SUVs, the UK still makes the most luxurious SUVs in the world, bar none. I have to say the Range Rover I may prefer that to the Rolls-Royce. I wanted to ask about the conversation you had with Charles Michel earlier, Guy. He seems to push back on the U.S. need to confront Russia, the U.S. need to confront China. They're going to go ahead with the Nord Stream 2 pipeline. They're going to go ahead with their trade agreement with the Chinese. Is this going to be a rift?
I think it is a risk. I think Europe is having to reassess its political posture on a number of different fronts, and certainly Russia, I think, is an easier one for them to handle, but I think Nord Stream 2 remains a huge point of friction, Matt. I think China, I asked Charles Michel whether or not the trade deal that was done with China was a mistake. He said no, it wasn't, but certainly there has been a significant backing off from that position, and I think it's going to be interesting to see exactly kind of where particular Angela Merkel, I think, sits in this challenge to try and figure out exactly what European foreign policy is going to look like here. She has taken a much more mercantile approach both to Russia and to China, but I think the mood music has changed over the last few months. The European Union adopting a much tougher stance, and I think that probably will provide some opening for an agreement between the United States and Europe on the best way forward. I don't think they're going to completely see eye to eye, though, Matt. And the other thing I should probably mention as well is the new Defender being shown off quite nicely as well.
Yeah, I will say that. I'm not going to talk about the various cars that are being used like Matt Miller. We'll leave that for the car section with Matt Miller later in the hour. There is a question about what kind of guidance we're going to get about whether the global minimum tax rate that we've heard some discussion about, which really plays into what you're talking about with the global economic recovery, as well as redistributing some of the money for IMF funds, for other sort of global monetary pools in order to revive some of these economies. How much are we going to hear about that later?
Well, I think today is the day you're going to hear about that, Lisa, and I think it is hugely important to these leaders that this happens, because I think it fulfills a number of different agendas. And we come back to China. There is a very strong desire, I think, amongst these leaders to deliver infrastructure projects that are going to counter the Belt and Road Initiative that China has been so successful in delivering, that has been hugely influential for them. I think redistributing funds is going to be a hugely important aspect to this. There has been this K-shaped recovery, not only within societies, but also globally. I think many economies that haven't been fully vaccinated are continuing to struggle in terms of their recovery. And I think there's a growing awareness that while we need to do something on vaccines, there needs to be a follow-up plan beyond that. And again, that then links back into this narrative as well as about what's happening with climate. All of these different aspects of the policy firmly linked, Lisa.
Guy Johnson, thank you for the report, and we'll see Mr. Johnson here through the day as well from Cornwall and the G7 meetings. We've got much more coming up. James Stavridis will join us in a bit. Admiral Stavridis, much more on the defensive political characteristics of this G7 meeting, his acclaimed book 2034. But right now, on the financial system of our international economics, no one is better than William Lee at the Milken Institute, his tour of duty at the IMF, and of course, expert on the Pacific Rim as well. I want to do the calculus today, Bill Lee, and of course, we don't do differential equations on Friday. We do simple math. G20, take away G7, I believe is a G13 nobody talks about. How does the G13, Eastern Europe and the rest, how do they observe this G7 meeting?
They're anxiously looking at what the G7 is doing with the corporate tax deal that they've come up with. To say that the smaller countries have to start to raise their tax rates, like Ireland and some of the smaller countries that have developed a model to say, we're going to develop our country by attracting foreign multinationals to our country by lowering our corporate tax rate, that is going to go by the wayside because they have to come up to 15%. That's going to be a challenge. The other thing they're looking at is, how on earth are we going to deal with China and the G7? The G7 already are in a mess in trying to find a way to cooperatively deal with China. China's a customer. China's a big input into their production supply chain. But no human rights. How do we live up to our values of human rights and worker rights?
You know, I'm going to believe that Michael Milken, taking advantage of William Lee in employment, dialed 1-800-BILL-LEE and said, Bill Lee, on that tax plan, is it dead on arrival? Every report we see from Hungary, from Ireland is major pushback. They want to exempt the City of London, which is absolutely absurd. Is it dead on arrival?
Well, it's dead in the sense that no one really agrees firmly that the corporate tax is the best space to use to finance government spending. One of the greatest controversies among economists is who bears the cost of paying the corporate tax. And studies have ranged from as low as 20% workers paying to as much as 100% workers paying. And most studies show at least over 50%. So raising the corporate taxes pushes the burden of paying that tax more on the workers. And that's a very big controversy that has yet to be settled. And for the G7 to rely on the corporate tax as a base to finance government expenditures is a real political wild card.
Well, just to elaborate a little bit, Bill, some people would push back and say, actually, if you look at corporate profits, they've increased dramatically. Why couldn't it come out of that rather than from the workers? I mean, why is that the obvious person who's paying for it?
Well, I think the political movement now is to stay away from taxing workers, especially lower paid workers. And so we want to try to tap into the resources that the very rich have. The question is the corporate tax the best vehicle to do that? Because so much of the corporate tax is shifted into consumers, workers, and people other than the owners of capital. We already know that corporate taxes are unfair in the sense that it's a double taxation. The taxing the corporate income at the source as well as at the shareholder level in taxing dividends. So those questions of incidence have plagued economists for generations, and there's no clear answer. It all is polluted by a lot of politics that govern.
Right. So let's try to strip out the politics and use an empirical example. And I'm looking at President Trump's tax cuts. And you'd expect the reverse to be true if that were the case, that a tax cut should juice growth and give more money to the workers. Is that what happened?
Well, what happened with the tax cut with the Trump administration is that so much of the corporate profits that were released went into share buybacks. Now, the question is, did the share buybacks lead to more investment? If you look at the data and the research that I've done, it shows that the share buybacks actually lead to more investment, but there's a huge lag, almost as long as 3 to 4 years before we see that investment take place. Right now, we have the highest level of investment in the U.S. for many, many years.
Bill, one of the biggest problems with corporate tax, beyond the double taxation issue, which I'm not sure everyone has fully wrapped his or her head around, is what companies do to try and avoid it. Often here in the U.S., or here in the U.S., I'm in Berlin, but my home in the U.S., they try and avoid it with debt financing. So we're basically pushing these companies into some more risky financing solutions. Does that turn around when you see the tax cut, as Lisa pointed out?
Well, one of the things that Mike has always emphasized to me is the corporate capital structure really matters. And pushing people into more debt finance has the impact of changing the shape of investment. Investment now goes into more safe projects because the one thing that debt holders want is to get their money back. They couldn't care less that profits lead to more investments that lead to more productivity. They just want to get their money back. So if you tell a borrower, take my money, but make sure you give it back to me, all he's going to do is to invest in the same projects that worked in the past. We're not going to get the innovative investments that we need to drive productivity and raise the standard of living among workers and the rest of the world.
Let's talk about the possibility of getting a global minimum tax. We've already heard reports that the UK wants to exempt the City of London, and the City of London has a bigger GDP than the Republic of Ireland. If we all start asking for these little loopholes, is it going to be possible to get the kind of blanket global minimum tax that they've set out for in the first place?
This is the slippery slope of getting exemptions and loopholes. And this is the one thing that has made the tax system in the United States and the rest of the world fail, which is to create so many loopholes that regardless of what you do with the rate, the amount of revenue you raise is actually much less than anticipated.
So, Bill, we're talking about the corporate tax rate, and the backdrop of this is a huge question mark about the trajectory of the global economy, whether we're heading into an inflationary period, whether it's going to be disinflationary post the pandemic boost that we're getting from consumer prices. Where do you stand on this, especially as we see the bond market weigh in and say inflation is not a concern?
Well, Lisa, we, I think, are seeing the face of the new shape of inflation in the post-pandemic world, supply-side induced price jumps. Now, price jumps that clear the market because of supply shortages, to me, is not inflation. It's not regarded as inflation by the Fed or any other central bank. Inflation of the sort that they worry about is the corrosive increase in wages, costs, and prices that firms fail to be able to keep up with, that erode profit margins and worker and savings and worker wages. That's kind of corrosive, continuing rise in prices that exceed expectations is the sort of thing that everyone is watching for, but there's no sign that the supply side price jumps, which is not inflation, is going to lead to that corrosive, continuing inflation that we had in the 70s.
Billy, I want to end on your wheelhouse, which is the Pacific Rim. Every indication I see is of a pricing for boom. Now, they haven't had the fiscal stimulus the United States of America has, but do you frame out over the next 12, 24, 36 months a Pacific Rim boom?
I would love to, but the kind of supply side shortage overhang and the overhang of China in the Pacific Rim is really distorting the picture of where growth is going to come from. The Pacific Rim has so much depended upon China as an intermediary and also as a final demand market that without China coming online and being a locomotive for the Pacific, it's going to be very difficult for the rest of the countries to grow. Right now, China has a dual strategy of investing in itself, developing its domestic markets, and almost withdrawing from the world, except in very strategic ways. The strategic ways is to dominate the supply chain in technology.
That phrase is so sensitive and so current. I mean, we could talk to Admiral Stavridis about it, but Bill Lee, to say that China is withdrawing from the world, and yet our listeners and viewers are familiar with the expansion of the South China Sea and of the Belt and Road Initiative. Which is it?
They're withdrawing their domestic markets from the world because they want to develop their technologies. They're expanding their military and political influence in the world because they want to be recognized as a large country power and yet still have the benefits of WTO emerging market status. They want to have their cake and eat it too. And that's the tension the G7 is going to have to deal with.
Pairing these two ideas together, this idea of where inflation is going and the fate of China, I'm wondering how much the change in China's economy is going to feature in the world inflation outlook. The idea that China was the factory to the world, it was the low-cost factory, and it was importing disinflation overseas. Now we have a very different China, a lot wealthier, withdrawing liquidity, trying to upgrade itself into developed market status. How much does that reverse the disinflationary trend that we've seen over the past 20 years?
That's a great question, Lisa, because what we see about the new face of inflation in China is happening right there. The factory prices have gone up by 9%. And all down the supply chain in China, we see more and more price increases. And yet, at the consumer level, we see prices going up at 1.8%. So what we see is a profit margin squeeze because the Chinese don't want to destroy the domestic economy, and they're putting in price controls at the factory level to contain a lot of these commodity price jumps. And I think that's a very successful way that they're implementing to try to limit the follow-through of price jumps and preventing it from spiraling into the corrosive inflation we had in the 70s.
Billy, thank you so much. Greatly appreciate it. With Michael Milken and the Milken Institute, their chief economist. Lisa, Bill Lee, I guess lifting the market there as well. We got a very nice movement here. And I really want to frame, Lisa, the VIX, the volatility index on the Standard & Poor's 500 from 17 down to 15.89. That's an extraordinary start to a bull market Friday morning.
Yeah, well, if you have yields this low and you have people becoming complacent with the idea that inflation truly is transitory, it's risk on, and you're seeing it in every single asset class. I just wonder how long that can continue. I mean, how long can we continue to see CPI prints, core inflation rise the most since the early 1990s before people start to get a little bit more concerned, Tom?
Yes, our guy Johnson, Lisa, just reporting on the royal family. They will attend the G7 meetings. I believe this is news, Lisa. Guy Johnson saying that the Queen is to join Prince Charles and Prince William, among others, in Cornwall at the Eden Project, and I believe this will occur pretty soon. This will occur perhaps at 1:15 United Kingdom time, which I believe is in like an hour or two. We may get images of that.
But the real question, Matt Miller, is what car will they drive up in?
They will drive up in a Range Rover, more than likely. The Queen herself drives an old Range Rover, a Land Rover, actually, and of course, her husband did as well, famously.
Are you making this up?
The kids drive, I think, different cars. I remember Prince William had a Golf when he first started, and they're more into flashier, racier cars than the Queen.
Tom, do we care? I mean, honestly, what are you looking for coming out of the G7 compendium here?
Well, you know, the do we care thing is a really, really important statement, in that this was a manufactured event. I don't have the history in front of me again, but whether it was G3 or G5 or G8 ex-Russia, now G7, but every once in a while, it is a do we care meeting. And my experience, Lisa, is it sneaks up on you. G20 in Pittsburgh had some substance to it. I have the clearest memories of being with Prime Minister Brown. John Snow, the Treasury Secretary, was sick, and John Taylor of Stanford sat in as Undersecretary, and all of a sudden the London G7 finance ministers meeting had value. You never know when it's do we care, Lisa.
Well, and I think that right now is such a pivotal moment as the alliances try to refigure themselves ahead of what's expected to be a contentious period, particularly between the Western world and China.
We will see. We're going to get the day started here on international relations with the G7 meetings. We just saw Mario Draghi of Italy land in Cornwall. It is a day for President Biden to greet the leaders of the G7. But I'll tell you, our major story has to be the markets and the stunning yield move. The real yield, negative 0.93%, is truly shocking to the inflationistas out there. Coming up, on the defense of the G7, James Stavridis, the former NATO commander. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg Surveillance, thank you so much for being with us. Lisa Abramowitz, Jonathan Ferro, and Tom Keene. Mr. Ferro is off. Matthew Miller doing yeoman's duty for us in Berlin. I believe Romaine Bostic's on the Sikorsky and is inbound for the next hour. Right now on G7 and on these markets, it is thrilling to give you your beach reading for the summer. It's not a secret that my book of the summer is 2034. It is by Elliot Ackerman and James Stavridis. It is absolutely stunning. This is a scary, dangerous book. It reeks of a Netflix movie, and maybe we'll see that. Not your usual expectation from Admiral Stavridis, but there it is. It is a triumph. The author joins us this morning, the former NATO commander. James Stavridis, I want to go to the work of Richard Haas in his Wonderful the World, and particularly John Mearsheimer from the University of Chicago, and it's your fault. They suggest, with respect, that the G7 world and that the NATO countries overreached and expanded too far east too quickly for Mr. Putin and Russia. Did NATO and Europe overreach to pick up Eastern European countries?
I don't think so. It's always easy in hindsight to say, hey, we coulda, we woulda, we shoulda done something differently. But if I could rewind the clock to the days when the wall fell, you got to remember the zeitgeist of the moment. There were not NATO tanks rolling into Prague. There were not NATO aircraft flying over Warsaw. Those countries were begging to join NATO. And they wanted to join NATO because they'd been under the boot of the Soviet Union. I don't see in a real world where we could have just said, no, you stay over there. We would have delivered them back to Russia. Would have been a bad moment in my view.
Long ago and far away, Admiral King and his gentlemen with their courage, folks, the Tom Hanks movie of this year on the courage of the Navy across the North Atlantic in 1941. James Stavridis, they got together off, I believe, Newfoundland and did the Atlantic Charter. Now we have the politicians with a TV moment doing a new Atlantic Charter. Is there any substance to this new Atlantic Charter?
I don't think there's anything new in the new Atlantic Charter, but that's okay. What it reaffirms is this transatlantic bridge that frankly has been a little creaky for the last 4 years. Now it's gaining strength, gaining airspeed, and I think in this post-Brexit moment, it makes geopolitical sense to kind of draw a line under that relationship between the United States and the United Kingdom. I'll close, Tom, by saying, even as we're having this conversation, what ship is at sea? The 65,000-ton aircraft carrier, Queen Elizabeth, with British escorts, British submarines, British auxiliary ships. We would call that a carrier strike group, and it's headed to the Indian Ocean and into the South China Sea. They're a good ally to have.
James Stavridis, in your book 2034, folks, and I'm going to be honest, it's so damn good, I'm going to be very careful here not to give it away, but the heart and soul of 2034 in our modern technology is a lack of communication. It starts in that opening scene in the South China Sea. How does this G7 set up a communication process to avoid your 2034?
First and foremost, it's about cyber and cybersecurity and protecting our networks. And by the way, protecting undersea cables as well. That comes up in the book. It's this putting together the technologies of cyber, of space, of undersea control. All of that has to be protected. That's a job not just for NATO, because NATO's in the end a regional alliance. That's a job for all the democracies. I think that's going to be a significant part of the conversation today in Cornwall.
Admiral Stavridis, there's a question about the alliance and how strong it is in coming up with a strategy with respect to China. There is, as we get the arrivals at the G7, we have Angela Merkel, German Chancellor, arriving. And Germany has an incredible trade partnership with China, even as it does take a harder stance. How much of a consensus is there on the right approach for the allies versus China in terms of reconfiguring trade?
I think that's the through line for G7 to NATO. And in fact, the Atlantic Charter is all part of this. And one central element to this, Lisa, that you'll be well aware of are the Chinese claims of territorial ownership in the South China Sea. We are pushing back on that by driving our ships through those international waters. That's a set piece that opens 2034. In the today's world, the Brits are headed there. The French are doing it. The Germans have pledged to send a ship there to stand with us. A lot of it derives from concern about human rights, but also your point about trade and access to Chinese markets. I think there's going to be a continuous conversation about China and Western China relations that run from geopolitics to geoeconomics to mercantile to market access.
How good of a job has the Western world done at vaccine diplomacy, at shoring up support from regions near the South China Sea in their outreach to try to help us all get out of the pandemic, versus China, which has been more aggressive, or at least aggressive on a PR stance, about their efforts on that front?
Yeah, this is a reflection of the clever, capable Chinese strategy. One Belt, One Road, or sometimes called the Belt and Road Initiative, BRI. It's a clever strategy that seeks to engage China geoeconomically in a mercantile fashion, and vaccines have become part of that. That's why the president's announcement of 500 million doses, no strings attached, Pfizer, gold standard, coming from the United States, that's a big deal, and it kind of wraps together, if you will, the 3 C's of the G7. That's COVID, China, and cyber. We've now hit all 3 of those.
Admiral Stavridis, Angela Merkel is about ready to descend upon her last G7 meeting at 66 years old. She is esteemed and venerated. She is a quantum chemist from Eastern Germany. What has been her chemistry, her impact on the Western world, your tour of duty at NATO, and after that?
I met with the Chancellor many, many times, and honestly, there is no leader that I would put above her in terms of her integrity, her willingness to make hard decisions. Germany, a nation of 80 million, took in 1 million refugees from Syria. The United States took in less than 20,000. She made the hard political choices. She's a 4-term chancellor. She's like FDR, elected 4 times to office. I cannot say enough good about Angela Merkel. I hope she does not go gently into that good night back to a physics lab somewhere, and I don't think she will. Yeah. She's got my vote to be the Secretary General of the United Nations.
Well, there you go.
To do so.
Stavridis working on the resume for Merkel. Matt Miller is in Berlin, and of course she celebrates a political domestic victory, Matt, in the recent days.
In recent days, but you know, those polls come and those polls go. I think the Admiral's point is an interesting one. Merkel would make a great Secretary General. When I attended the G20 meeting in Hamburg, she got a standing ovation from all of the other leaders when she entered the opera hall there at the end of the meeting. She essentially was leading the G20, and it'll be interesting to see what she can do here at the G7. To me, Admiral, the most interesting thing about Merkel is all of the good deeds she's done, you just listed, and yet she is so insistent on building this Nord Stream 2 pipeline to Russia, essentially funding, you know, billions, hundreds of billions of dollars to Vladimir Putin to finance things like the annexation of Crimea. Why?
I think it would be hard to find any leader who bats 1,000. In other words, I think all of us can look at any of our leaders and say, hey, you got this one wrong, you got that one wrong. To the pipeline question, Merkel, I would say to her chancellor, you got that one wrong. And it reflects sometimes our greatest strength can be our greatest weakness. And in many ways, she wants to build consensus. She wants to pull Russia to the West. There's a strategic sense to that, but it won't work with Vladimir Putin. Therefore, I would score her less perfect on that particular point.
Admiral Stavridis, have you framed out Russia after Putin? I guess none of us are doing that. Merkel is thinking forward always, as you say, the chancellor and others. What does Russia look like pulled to the West after Putin?
Let's hope it happens. And if you look at the history of Russia, in terms of leaders, you roll the cosmic dice. Sometimes you get Peter the Great, the next time you get Ivan the Terrible. You get a Joseph Stalin, then you get a Gorbachev. Those dice landed on Vladimir Putin. He will be the czar of all the Russians till the day he dies. He's alive in 2034 as an octogenarian. But what comes afterward, let's hope the dice land on a different kind of leader. It's possible if you look at Russian history. The strategic opening to pull Russia away from China is a powerful moment for the West. It won't come until Vladimir Putin passes on to the great commune in the sky.
James Stavridis, thank you so much for joining us this morning, folks. My book of the summer, 2034, I really can't say enough. It is a wonderful, piercing beach read. Matthew Miller on radio and television. Do I make a note that the chancellor, I believe, exited the airport in a Jaguar? Would this be true?
Yeah, that is true. And of course, they make those in the UK as well, so they tend to lean on them. I got to say, I cannot wait to read 2034. I'm obsessed with spy novels from John le Carre to Norman Mailer to Ian Fleming. And I think it's going to be great to take it forward. I can't wait to sit down with that book.
It's really, really an important book. And what is so important, folks, and Lisa Abramowitz, like anything from Stavridis, it starts strong. I can't say enough about the first chapter, and you go, oh, really? This isn't about the Navy floating around the ocean. This is something different.
Well, and it might be fiction, or is it?
It
and
might
this
be,
really,
yeah.
well, I mean, it shows how the balance of power has shifted.
Yeah. Let me do a fiction of a data check here. It's a fiction. If you're in the triple leverage all cash fund, this data check is a fiction. Futures up 6,
Stay
Dow
tuned.
Futures up 81. The VIX is at 9. Oh, I'm kidding. Stay with us for more coverage. Our Guy Johnson in Cornwall. This is Bloomberg. Good morning.
With the First One News, I'm Ritika Gupta. The world's richest governments are under mounting pressure to help poor countries fight climate change. At the G7 summit in the UK, they'll get a new chance to do something about it. Leaders of the G7, including President Biden and German Chancellor Angela Merkel, are meeting in Cornwall, England through Sunday. On the agenda is a discussion of how to help finance a shift to cleaner energy in low-income countries. Global oil demand will recover to pre-pandemic levels next year. That's the forecast from the International Energy Agency, which urged OPEC and its allies to keep markets balanced by tapping their spare production capacity. The IEA predicts that the world consumption will surpass 100 million barrels a day in the second half of 2022 as developed economies bring the virus under control. A prominent Harvard Medical School professor that has resigned from the U.S. FDA advisory panel over the agency's decision to approve Biogen's Alzheimer's drug, Aduhelm. Dr. Aaron Kesselheim is the third person to quit over the clearance, which he called, quote, probably the worst drug approval decision in recent U.S. history. 2 big clinical trials produced conflicting results on whether the drug could slow cognitive decline. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacwan. We'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
States are really scaling back on their data. They're reducing the frequency that they're publishing COVID-related data. You know, I know that everybody feels like we're on the home stretch, and we are, but now's not the time to scale back. We very much need the data in front of us to make sure we're on the right path and make sure that we don't quit before the game is over.
Jennifer Nuzzo there from Johns Hopkins on the pandemic is away. What we're going to do this morning is digress. Andrew Pekos is esteemed out of Rutgers in Pennsylvania and at Johns Hopkins Bloomberg School of Public Health. And long ago, Mr. Pekos understood that, well, you know, you took biochemistry and Leninger and you got through organic chemistry and that. And buried in it was Rutgers 355. I don't know if you remember this, Andrew. I pulled it off the website. But Rutgers 355 was about scientific writing. And that's a course at your undergraduate level where you actually realize someday you may have to commit research, commit science, and publish. It is an uproar in the Alzheimer's study right now. And Dr. Pekos, we thought we would get perspective on you, on people like you resigning from institutions because they disagree with what the FDA did. Talk to us about the sanctity of research. Talk to us about how this stuff gets published and what you do when politics intrudes.
Well, you know, it's clear that scientists are always focused on the data, or at least should be. And the data tends to drive our decisions, and we tend to make black and white decisions about things based on the data. Certainly in the case of the Alzheimer's drugs, there are other factors that are really pushing forward here. You know, any chance, if you talk to people who are suffering who have family members suffering with Alzheimer's, you know, everybody just wants a chance to try to get something better for their lives, for their loved ones. And so one understands that there is some emphasis on, if something has a glimmer of hope, that perhaps FDA would move forward to try to allow that into wider use. The data in those studies are very, very controversial, and what I'm afraid we're doing is giving people false hope that something might be working, yet when they look back later on, they'll see that the data supporting that, whether or not that works, was really rather flimsy. And that erodes our trust in the scientific process and in the process of getting drugs into safely and efficaciously into the population.
Dr. Pekos, that's exactly where I wanted to go, to the credibility question around the FDA, especially at such a pivotal time with the vaccination process underway. How much does a controversy like this undermine the FDA's credibility as we continue to try to get a critical mass of individuals vaccinated from COVID?
Yeah, it really does question the process, which is in parallel. When you saw the process go forward with the COVID-19 vaccines, there was really open sharing of data. Results were clearly discussed. Conclusions were quite clear, and the process was really fast-tracked to go forward. In this case, you've got the science, which is mixed at best about the drug. yet the approval is moving forward. And, let's not forget about the cost of this drug. I mean, this is an incredibly expensive treatment, which this data is not suggesting has a very high likelihood of significant success. And it's those mixed signals that is really going to eventually erode the trust of the population in the process.
Dr. Pekosh, I want to talk about the danger of an eroding of confidence at such a crucial time in the COVID-19 pandemic. I was out this weekend. I was out the other night. The pandemic is over in New York City. People are not wearing masks. The restaurants are crowded. People feel confident. And frankly, the mask policy is a joke. Make it up as you go along. Where you go, it sort of is a different policy, place by place. How important is it to get more people vaccinated to prevent another resurgence that could potentially be highly damaging given the Delta variant?
Well, all we have to do is look at the situation in India and Nepal, and now we just look at the situation in the United Kingdom, where variants of COVID-19 have become the dominant virus in those populations. In the UK, despite a somewhat effective vaccination campaign. And those variants have different properties that increase the ability of this virus to spread, and it looks like potentially cause disease in the population. Anytime we give the virus a chance to get to know its host better, to get to see immunity against it, the natural selection principles laid out by Charles Darwin suggest that variants that are more fit will emerge. And particularly in the U.S., we can't look past that because we really have sort of a dual population. We have the unvaccinated and the vaccinated. In many places, the unvaccinated are larger than the vaccinated populations. And that just sets up a situation where the virus can see immunity, can go into people who don't have immunity. And that back and forth is essentially how my laboratory selects variants when we're studying them. So we're setting up that experiment in the population, and that's not a good thing for us to be doing.
You bring up Darwinian choices. The virus wants to survive and thrive, and a large part of that means not killing its victims, right? Previously, we've seen these viruses mutate into less fatal disease causes. Is that the case, you think, as well with COVID-19?
Well, this is where research is going to be incredibly important because we've essentially protected a good portion of the population that are suffering from a very severe disease. So now we're really looking in the parts of the population which previously didn't show a lot of severe disease, and we're looking for small changes in that population. So that's something that has to keep going. We have to remember that history has dictated that viruses will get less virulent as time goes on, but that's usually a combination of immunity in the population and changes in the virus that make that a little bit less virulent. And so those two things have always gone hand in hand when we've seen pandemic viruses lose their virulence over time. So we can't just say that it's the virus changing to be something less. It's a combination of the virus changing and immunity in the population, which lowers the disease severity that we see.
Dr. Pekosh, thank you so much, particularly those comments on Alzheimer's, something that's touched all of us. He is with Johns Hopkins Bloomberg School of Public Health. Mr. Bloomberg, of course, principal of Bloomberg and this television and radio property as well. Lisa, we got to look at the markets. I have a different equity market. This is a stronger equity market, Lisa, than we've seen the last number of days at this hour. The VIX nicely under 16.
Yeah, we've seen a stronger equity market on the heels of those lower bond yields. They're ticking up a little bit today, but still way off their average over the past couple of weeks. And you think about how you pair that with the idea that commodity prices, based on the Bloomberg Commodity Index, the highest since 2015, Tom.
Yeah, well, it's going to be interesting to see. Right now, we have to turn, as we always do. I'm typing away here to Amy in Mission Control. Matt Miller, I'm sorry, it's time for obligatory car talk, and we've just got to look at the royal family's arrival here. I assume they jet in, but they've got to get for a helicopter in. They got to get to the Eden Project here. This will be at 1 o'clock-ish our time, 6 o'clock-ish UK time as well. What does the royal family, how do they get about, Matt Miller?
Well, the royal family, Queen Elizabeth famously likes to drive herself in a Land Rover, I believe a Series 1, but otherwise they're chauffeured around in a Jaguar Bentley.
There it is, obligatory car talk. Stay with us.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Crypto is a nuanced issue, and it's possible the U.S. gets crypto wrong.
Inflation expectations are back. I think the Fed is going to need to recognize this risk, certainly over the next year.
The Federal Reserve, they take inflation very seriously. They think about the data.
Market, the bond market is focused on this labor picture.
I would suspect the Fed is welcoming this relatively nuanced volatility.
We need to see whether these supply issues are indeed short-term, but if they are going to be persistent, then central banks probably will have to move.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A Friday simulcast on Bloomberg Radio and Bloomberg Television. Our Guy Johnson in Cornwall with all going on at the G7 meetings. Our Romaine Bostic in for Jonathan Farrow with the bull market. What is the color of the Bostic bull market, Romaine?
Well, it's green today, on this Friday, Tom.
Well, it looks like it's green today. Futures up 9, Dow futures up 103. But the real story, always for Bloomberg Surveillance, is the foundation across equities, bonds, currencies, and commodities. And Lisa, I'm sorry, you nailed it with the high yield paper or whatever you said. 1 basis point from record tight. Is that right? You said that earlier?
What a way of building credibility. You nailed it, whatever it was that you said. I'm not sure. Whatever you said. It was great.
I mean, it's great.
The issue here is you've got lower yields. And when you get the gravitational force lower in Treasury yields and that benchmark borrowing rate, you get risk on. And that tends to be what happens, at least in this new paradigm, to use the word that you love and hold true to your heart, Tom. The idea here that lower rates means more stimulative, means more risk on. And you see that with nearly the lowest yield ever on high yield bonds.
Well, we will see in the equity markets. We'll do a data check here in a moment. Just, Lisa, to begin, your thoughts on a G7 meeting, the royal family to surprise and attend Cornwall this afternoon, our time, as well many others landing now. We saw Draghi land, we saw Merkel land. And as you say, is there substance to it? That's the arch debate.
And today I think that there could be if they give some sort of guidance on the global minimum tax. Today's about the economy, and frankly, that's where they could potentially give the most guidance in concrete policies. How much consensus is there around a global minimum tax rate of 15%, Tom?
Romaine Bostic, I'm supposed to go meme with you, but what I really want to go is to an understanding that there's an other side of the trade and the idea that everything goes up and the media loves to show GameStop and whatever it is going up, up, up. Somebody else is on the other side, and we see two hedge funds in the last 48 hours reported to take some serious losses, believing these puppies would go down.
Yeah, and we've seen this happen before in the past. Of course, you know, there's always somebody who gets left holding the bag. I mean, look, the 4% drop that we saw here, it's not totally unexpected here, but you always sort of look at these trades and you sort of wonder, Tom, not only who's buying, but I guess more importantly, who's really a believer in this, who's really buying this for the longer term, and whether those are the people that end up getting hurt by this.
Fine for the longer term, which is to get into Monday morning as well. Romaine, help me here with a data check here while Lisa waltzes to the wall to give us perspective. Futures up 9, Dow futures up 102. The VIX, Romaine, is really different on this Friday, 15.73. What else do you see?
Yeah, the VIX it continues to soften here. You see dollar weakness once again, or softness, I should say, not necessarily down on the day, but relatively flattish. And we go back to that yield picture and how it folds into the equity market, Tom, and that 42.37, of course, which is that record high from yesterday, that record high that we're going to open at apparently today here. It is still a very modest crawl up to that record high here. And I think you have to take a step back. When you talk about how much of a boost yields can give, that boost is going to be relatively contained considering that we were already low.
Well, we will see. We have a briefing this morning, and of course, it all wraps around the G7 meetings. Lisa, what do you have?
Let's waltz into those G7 meetings. Today, they begin in Cornwall, England. The key issue today is going to be the economy. How do you get the world back up to speed post-pandemic? Interesting to hear comments about the K-shaped recovery, how much these nations are committed to redistributing about $100 billion of IMF funding to poorer nations, and how much are they committed to the global minimum tax rate. Interesting to hear also how much they are going to use some of this outreach to generate support for the trade plans that they have with China. 10 a.m., I am very interested to see what the U.S. Michigan consumer confidence, consumer sentiment survey shows, particularly with respect to 5 to 10-year inflation rates. We saw the last survey with the expected inflation rate over this time period surging to the highest since 2011. Are you going to see a continuation of this? We know that consumer expectations tends to lead actual inflation. Does the Fed's gauge of inflation matter when you go to the grocery store, when you go to the auto lot, and you see very different kinds of price increases? Then 2:45 p.m., this really feeds into financial stability concerns. As people get complacent with no inflation, despite what they might see in the stores, how much do they build up risky positions that pose a threat down the line? Janet Yellen, Treasury Secretary, presiding over the Financial Stability Oversight Council meeting. How much will they flag some frothier aspects of the market, some of the memier areas as potentially posing risks down the line, Tom? So far, they have taken a sanguine approach. Does that change?
We will see. And again, on a Friday here, the news flow, maybe not quite as pressing as we saw with the ECB here earlier this week, but nevertheless important. Katie Dixon joins now with the Northern Trust Wealth Management Company as we try to reframe, I guess I would say, into the Fed meeting next week. Katie, what have you changed at Northern Trust, an August institution in Chicago? What have you changed in your allocation? What has been the distinction of the last couple of weeks between equities and bonds?
Well, Tom, we have been pretty consistently risk on since we started to come out of the pandemic, and we continue to feel really confident about risk taking right now. And I think it's really been so interesting to see the bond market come around to that point of view even more so in the last week or so, as interest rates and inflation expectations have come off the boil, and more bond investors have come around to the Fed's point of view that the inflationary pressures that we're seeing now will be short term, and that longer term will be back to that sort of old normal low inflation environment. So low inflation, low rates, positive economic growth, and strong earnings, that's a pretty good backdrop for risk taking.
Katie, riddle me this. The old normal also included pretty slow profit growth. So how do these messages cohere? The idea that the bond market is complacent about inflation, but signaling low growth, and equity markets are looking at high growth, but getting confidence about low inflation. There seems to be a disconnect, no?
Lisa, it's always important, I think, to remind ourselves that the market is not the economy and the economy is not the market. So we went through a period of very low growth coming out of the global financial crisis, below trend growth for quite a few years. And we actually had pretty strong profit growth and actually really good returns for US equities in particular. So these two things can be disconnected. And we're certainly seeing that actually now, where we have this operating leverage coming to the fore with the earnings actual growth and as well as forecasted growth for companies that are just going strong double digits this year and even into next year. So we do expect very strong corporate earnings that will outpace even GDP growth.
But a lot of people, though, Katie, they were sort of betting on the economic recovery. At least when we saw the run-up in equities earlier this year, that seemed to be the trade. Yesterday, we hit that record high on the S&P 500 on a day where most cyclicals were not only in the red, but relatively deep in the red. Is that bet on the economy? Is that still a trade here that you want to make?
Romaine, it's really such a push-pull right now between sort of those cyclical value trades and those large cap growth, secular growth stories. And I think it's sort of a both and, not an either or for us at Northern Trust. We want to have exposure to those super strong long-term growth stories, the tech names in particular. But we also think there are legs to this value and cyclical recovery. And a couple of the things that support the both and from the value perspective are, number one, the valuation gap between growth and value still at a very, very high level. And then secondly, the earnings growth of value is going to outpace growth this year and next year.
Katie, what's the actuarial assumption right now? I mean, Lisa and I go back and forth on a 60-40 textbook split. What's the Northern Trust assumption here? Are you managing for a single-digit return?
Yeah, Tom, that's the big question. I think 60-40 portfolios are going to be challenged. The biggest challenge is that we're going into this period with very low bond yields and very high equity valuations, and we know that matters for long-term investors. Your best guess for your bond return is your current yield to maturity, and high valuations mean prospectively probably lower equity returns, even with strong earnings growth. So we do have that sort of mid-single-digit kind of forecast for risk assets.
Katie Nixon, thank you so much with Northern Trust. What I want to do in the minutes we have here before we go back to Cornwall and the G7, and Alicia Levine coming up as well. Romaine Bostick, I really want to talk about that collapse of the 60-40 portfolio. If you're not in the 40 bond, Romaine, what do you do in the equity market?
Well, look, I mean, a lot of folks who still have that 40, it may not be the traditional 40 in the Treasury market. A lot of that 40 right now, Tom, as I'm sure you know, is actually gone into corporate bonds.
No, I don't know that. Lisa knows that.
Well, okay, well, Lisa knows that. A lot of that 40 has gone into alternative assets, whether it's real estate. Now you got maybe a certain portion of that 40, maybe it's 2-3% sitting right now in crypto assets. So there are a lot of folks who've already, well, Tom, this is a brave new world that we're in right now.
He is so from the afternoon.
But here's the issue.
You don't say that in the morning, Romaine.
You can say that in the morning. You have my blessing, and I think he is absolutely right. You nailed it.
37,000.
The issue here is not just BitDog, according to Tom Keene, but it's the fact that people are investing in less and less liquid assets as part of that 40%. And my concern is how much do we focus on the more liquid assets getting sold off disproportionately if there's a dislocation, because you sell what you can. Right? And how much are we already seeing that? So that the activity is getting concentrated into a narrower slice of the most liquid assets as an outcropping of this incredible move to less liquid, privately placed assets.
This is really dead on. And Romaine, it comes to the idea we forget what negative 10% is or negative 18%. We're talking about corrections of 5%. That's just baloney.
Yeah, and look, a lot of people are setting up for that. And when you look at some of the fund manager surveys and you look at some of the strategists we talked to, they are sort of prepping themselves for this, Tom. And you've already seen the reallocation here. The idea here that a correction, a significant correction, has to happen here, and it's going to happen at some point.
But
it's going to, right?
Go ahead, Lisa, please. Help me.
The thing I'm struggling with is that everyone's prepping to buy the dip. I mean, yeah, they're preparing for the correction by preparing to buy it. So at what point do you just not get the correction? We've seen that time and time again. I mean, people are in triple leverage all cash. Can you believe that, Tom?
I'm absolutely shocked. Romaine, what's really important here is it's Friday. Very quickly, Romaine, it's Friday and we're going to be buried with gloom articles.
Gloom?
How do you digest those gloom articles?
Always.
Gloom? What gloom are you talking about?
It's
a wonderful Friday. It's a beautiful day here in New York City. Beautiful day all up and down the East Coast.
I'm worried.
Listen to him.
Yeah.
We're flowers.
Yeah, seriously, what is
wow,
this?
He's singing again. All right.
Josh Wingrove is on deck in Cornwall. Huge news flow from the G7 meetings. On radio and TV, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The world's richest governments are under mounting pressure to help poor countries fight climate change. At the G7 summit in the UK, they'll get a new chance to do something about it. Leaders of the G7, including President Biden and German Chancellor Angela Merkel, are meeting in Cornwall, England through Sunday. On the agenda is a discussion of how to help finance a shift to cleaner energy in low-income countries. John Gray made a name for himself by growing Blackstone's real estate arm into a behemoth with $115 billion in assets. Gray sat down with Carlyle co-founder David Rubenstein for David's new series, Bloomberg Wealth, to provide his insights on real estate investing.
I think it's still a pretty good time for real estate, and I'd say it for a couple of reasons. One is the warning signs for real estate are twofold: too much leverage, too much capital, and we don't really have that in the real estate system today. The other, too many cranes, too much building, and we're actually below historic levels in terms of new supply.
And you can see more from this interview with Blackstone's John Gray on July the 6th when Bloomberg Wealth with David Rubenstein debuts globally. The new series will feature exclusive conversations with the world's top investors. And China has approved 2 COVID-19 vaccines produced by Sinovac Biotech and Sinopharm for emergency use in children aged 3 to 17. The country's accelerated vaccine drive comes as the U.S. pushes for a new inquiry to determine how COVID emerged, including whether it leaked from a lab in the city of Wuhan. Bloomberg has reported that G7 leaders will call for a new study into the origins. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
World leaders meet. On the agenda, global tax, security, climate change. Tune in for extensive coverage from the G7 summit in Cornwall, England, and the NATO summit in Brussels. Live on Bloomberg Television and Radio.
The economy is in very good shape in the U.S. Household balance sheets, corporate balance sheets are in good shape. We are about a year away from full employment, maybe a little longer if job growth continues to surprise a little on the downside. But we've got fundamentals driving the economy as well as fiscal policy, as well as monetary policy. Basically, people can count on 18 months of very strong growth in the U.S., pulling up others around the world, too.
Adam Posen of the Peterson Institute there, a terrific essay to start your summer on nostalgia. Look for that in Foreign Affairs magazine. And Dr. Posen, truly one of America's experts on Germany from World War II forward. We announced, and moments ago we heard from the White House that Angela Merkel will visit President Biden at the White House, I believe, on July 15th. Joining us from Cornwall, Josh Wingove, traveling with the president. Josh, the symbolism here is still extraordinary. I go back to the shock of my early childhood of Adenauer in 1962, greeted by World War II veteran John F. Kennedy. It is a span of well over 60 years now. How will the greeting be for Merkel retiring as chancellor?
I mean, Merkel and Obama had a very special relationship, and good morning, Tom. I think that there'll be similar vibes between her and President Biden. You know, first on the agenda, I think, will be a carryover from the summit that begins today here in the UK. They want to show a united front. But, you know, under the, well, sort of one step below that, they're not in lockstep on everything. Of course, the Nord Stream 2 pipeline, top of mind on that one. They're at odds on it. Biden looks like he's more or less thrown in the towel and conceding, rather, that they're going to get this thing built. But, you know, I think this one is probably an important one to the White House to get before she goes out the door, given how many Obama people are in that. This will be the third world leader to visit the White House since Biden took office. The first two, of course, being the leaders of Japan and South Korea a month or two ago.
Team Biden is preparing for the day. They do this, folks, in Tregonna Castle, which is listed as an imposing castellated edifice. I love that. Inside the imposing castellated evidence, what is the goal of the Biden administration in the next 24 hours?
Well, they're going to have their sort of pomp and circumstance today, the arrivals of all the leaders who are trickling in as we speak. The first plenary session is this afternoon. They're going to have their big dinner and whatnot. Biden has kicked off the day by talking about the baton passed to them by the G7 finance ministers around the agreement for that 15% global minimum tax, at least 15%. Biden, of course, is trying to advance that domestically as well. Big question marks in Congress about whether they'll be able to get that through, either with Republican support or whether it's even possible to do it with Democrat-only votes, whether Joe Manchin cares about that kind of thing. Lots of balls in the air, but he wants to, I guess, gather some momentum from the G7 saying that this is a good idea. You know, we don't know how much sort of waterfront that kind of line is going to cover. It depends on what other countries do, and it depends on even the countries that agree to it at a sort of summit like this, whether their Congresses and the parliaments will actually pass it. So, you know, big question mark, but Biden is at least trumpeting that at the top. He wants that 15% minimum tax.
Well, there's a lot of pomp and circumstance for all of the leaders who are joining the G7 confab right now. And there's a question of who they are trying to send a message to, since this is largely a messaging exercise, or has been in the past. Is it to China, or is it to other nations around the world to get some sort of consensus in how to work with China?
Well, I think it's a little bit of both, and I don't want to disappoint you all. You can imagine the pomp and circumstance tends to dry out by the time it reaches yours truly here in the press van sitting here waiting for these events to go. But they definitely want to show united front to China. Biden has sort of tiered his events throughout his week-long trip to build towards that meeting with Vladimir Putin. Of course, after this, he's off to the NATO summit, and after that, a meeting with European leaders. You know, one thing we'll be looking for in that G7 communique is how many times China is said or unsaid. A lot of the messaging there will be designed to sort of square off against Chinese influence. Biden began that yesterday with his announcement of 500 million doses, Pfizer doses, that he's donating. Implicitly, that is to counter sort of a transactional brand of vaccine diplomacy that Beijing has been doing while the U.S. focuses on its own domestic campaign. So you're right, China top of mind. That Putin meeting, we're building to that. But I do think that Biden is a little more hawkish on China than some of his counterparts, including in particular Merkel and Macron.
Yeah.
They see more shades of gray on that file.
All right, well, look ahead to the NATO summit, Josh, where you'll be sitting in a van somewhere on the outskirts of Brussels. What exactly are the European leaders, particularly those European leaders in Eastern Europe, looking for out of the U.S. administration with regards to its commitment to NATO?
Yeah, I mean, I think we'll hear Joe Biden talk a lot about Article 5. You remember a few years ago, Donald Trump sort of set off a fury by suggesting that that was not an ironclad commitment, essentially that saying he might not necessarily have their backs. Joe Biden will sort of commit to that. Again, that Putin meeting is going to be hanging in the balance. But I think that, we're going to see less of some of the tensions that have animated the previous NATO summits, which, of course, were dominated by Donald Trump demanding that people pay more, spend more on defense. Trump framed NATO almost like a bank. Joe Biden is not doing that, so they're going to pivot a little more to the geopolitical role, tee up that meeting. I think, of course, Ukraine will be front and center as well.
Josh Wingrove in Cornwall in front of a castellated edifice. Thank you so much this morning. On Bloomberg Radio and Bloomberg Television, we welcome you on an interesting Friday, not to be subdued about it, but the shock and awe of yield we have to continue to circle back to. Lisa, what is the research of the why of the move from 162 down to 145?
Short squeeze. In a word, a
you
lot of
really
people
think
saying,
so?
Look, that's what a lot of people are saying, that basically everyone was positioned. The consensus was that Treasury yields were going to rise. And suddenly you have an increasing momentum behind this idea that maybe this really is transitory and the Fed is onto something. If you look at which measures actually saw the biggest increase in the CPI data, most of them were very specific industries that were, you could say, transitory. The idea of airfare, the idea of used cars, that counted for about a third of the increase that we saw in the CPI. I mean, there were very specific factors that led to this. And so people are looking at that and saying, all right, it will pass.
It will pass. I mean, Romain, the idea is it'll pass, and then boom, NASDAQ goes up 2 days in a row, the S&P out to a record high. Link it over to the equity markets.
Absolutely. I mean, a lot of people had been concerned here about that rise in rates that we saw earlier in this year, how that would crimp profitability, particularly for some of these growth companies here. The idea now that you have yields sitting below 1.5 and the fact that they've come down so fast here, really over the last 2.5 weeks here, I think has reinforced that trade. You're seeing a lot of people pile back into that. And more importantly, Tom, they're actually kind of selling off some of those cyclicals that were supposed to be a big part of that rebound.
I have
Lisa.
a question.
Yeah.
You guys both shrugged off the idea of a short squeeze. Why? Why is that not what it is?
No, it can be a dominant factor. I don't disagree, Lisa. I think the analysis is correct, but I don't think it can be taken in a vacuum. It can be taken alone.
Agreed. And I think that it goes to this idea of the factors that are going into higher inflation readings really are specific to the post-pandemic period.
Yeah, I've never shrugged off anything you've ever said, Lisa.
Well, that's Sarcasm Friday. Here we go, Tom.
That's the Bostic-Faro difference right there. Futures up 6, Dow futures up 65. We'll get through this, folks. The VIX 15.80, really showing the quality and character of this bull market. Again, the yield 1.45%. The real yield is negative 0.93. That is something.
My imitation of you. Is it working?
This is Bloomberg. Good morning.
He's just ignoring me.
in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro, Lisa Bramlett, and Tom Keene. John Ferro off today. Romaine Bostic with us here. We're looking at really fascinating yield markets. We'll get to that in a moment. On the equity markets, futures up 6, Dow futures up 72, and the VIX stunning in the bull market sense from a 16 down to 15.79. That's not a small matter to see here at 7:30 Wall Street time. A VIX of 15.79 is a changed equity market, a better equity market through the days. With a better look at individual stocks, Romaine Bostic.
Yeah, some of the individual stories out there. Let's start off with Apple here. Of course, a lot of speculation about that Apple car, a lot of doubt about whether that thing will ever get built. Well, Apple may be putting some of those fears to rest. Ulrich Kranz, who used to work at BMW, he was there for about 30 years. He helped develop the i3 and the i8 before leaving BMW to start his own EV company. He's now joining Apple. That news crossing yesterday and providing a little bit more reassurance here that Apple is committed to developing some type of electric vehicle. Again, we haven't actually seen the designs for this or any timetable for when it will happen, but a pretty big executive hire here. Keep an eye on that. Keep an eye on Snowflake, the software company down here in the pre-market by about 3%. It had an investor day yesterday. Some of the guidance that it gave seen as a little bit conservative by some of the investors there. That's why you're seeing the shares lower. Chewy actually also talking to investors yesterday and out with numbers. Overall sales were up by about 5%, and you had some improvement in margins, but the company talked a lot about labor shortages in its fulfillment center and the idea that some of those costs will probably go up as it tries to get more people in the door.
Why is that bad news? Stop. Romaine, this drives me absolutely nuts. The number of Chewy boxes in the manse I live in is rivaling Amazon. It's bad news. Their business is so good they can't get labor?
Well, it's bad news that they're going to have to pay more to get that labor, Tom. I mean, to pack all those boxes and all those chew toys that you're buying, you need people to do that. It's a huge logistics operation.
Romaine, you've hit the third rail of surveillance, Romaine. About 3 chew toys, and 2 of them are already chewed up. That's the racket.
He uses AirPods for chew toys. Carry on,
we
Romaine.
do that. Continue.
It's a nice racket, and if they get past some of those cost issues, then maybe it should all work out for Chewy. Flip up the board here real quickly, Tom, because this has actually been a great week here for the healthcare companies, specifically in the biotech space. Biogen, obviously, the big outperformer on the week. It's already up almost 50% over the last 4 days, up another 1% here in the pre-market, 420. CureVac, though, going in the opposite direction. Some news out of Germany saying that they're not going to include CureVac's COVID shot in its latest campaign. Still waiting on the European Medicines Agency to approve that. And finally, keep an eye on Vertex Pharmaceuticals. This was a huge deal, Tom. They were actually developing a liver treatment, basically saying they're going to abandon the development of that, saying that right now the trials that they're having aren't really showing much promise. You're seeing those shares down about 14% here on the day, Tom.
Romaine Bostic.
Thank you
so much. What we're going to do on radio is a chart. I mean, on a Friday in the edge of summer, 90 degrees, and it's a little cooler today in New York. Charts work on radio. This is an early candidate for chart of the year. This is the real yield just before the pandemic. And all you got to know on radio is we went negative, and then we went bigger negative, and we stayed bigger negative through gloom. And then Lisa Bramowitz, there was the hope and the prayer of a vector back towards 0% negative inflation-adjusted real yield. And the last 2 weeks have been one big oops.
Yeah, well, and charts on radio are always winners, but this chart really is terrific. Basically, the gist of it is you are losing money in real yield if you take a look and you base your expectations on inflation and what the bond market is currently pricing it, and that negative yield is back near negative 1%.
Negative 1% would be stunning.
It would be stunning based on where we are in the economic cycle.
Anthony from Sparta just emails in and says, have another Tang Mimosa.
Okay, well, you have another Tang Mimosa. We're going to get all the answers to the bond market mystery. Subhadra Rajappa has them all. She's standing by. Societe Generale, head of U.S. rate strategy. And there is this question of what has been behind the incredible rally in 10-year treasuries. I was saying a lot of people are attributing it to a short squeeze. Is that it?
Well, I think it's one of many factors, right? We're definitely seeing a little bit of positioning being very skewed towards shorts, and typically when you see, when positioning gets a little bit skewed, you tend to see a short covering rally. But it's also, we're seeing very, very strong demand coming from, real money accounts, overseas accounts in auctions this week. If you look at the auction metrics, both indirects as well as directs, the participation has been very, very strong. So the primary dealers are not taking down these auctions. It's real money investors and end investors that are taking down this auction. So it's a combination of positioning as well as strong demand from end investors for treasuries, which I think is kind of counterintuitive. Like you pointed out, at this stage in the recovery, you should be expecting a gradual rise in yields. So in some respects, the sort of rally that we've seen in the last week, at least to me, is somewhat counterintuitive.
So that really raises the question, how much does this rally have legs? Or is this a one-off, a sort of positional shakeout that's poised to reverse?
I think I'm more in the camp that, once we get this position shakeout, we should see yields start to head ever so gradually towards, a higher trajectory. And in some respects, where we are right now is very similar to what we saw earlier on this year. When 10-year yields were at 80 or 90 basis points when we began the year, we thought the world would come to an end when 10-year yields got to 125. The Fed's definitely going to, talk down the market. They're not going to let yields rise to 125. Guess what? The Fed just stepped aside and said, you know what? It's okay for yields to rise. We're exactly at that same juncture heading into the June meeting where 10-year yields at 145. The Fed is gradually thinking about paring back asset purchases. They're going to look at 10s at 145, the equities at all-time highs, and say, you know what? We have a little bit more room to sound a little bit more hawkish on the market. And if yields rise, so what? There's a lot more room for yields to rise. So that's kind of where I think the big risk heading into next week is that there's a decent amount of complacency in the bond market that the Fed's going to keep things status quo.
Well, talk a little bit more about the complacency and I guess the potential here, Subhadra, for volatility. Should we finally start to get a little bit clearer communication about the Fed? Because while they may be standing pat right now, I mean, they've also made it clear that at some point things are going up. And we're going to get that communication, some sort of roadmap, hopefully soon. And I'm wondering, as we start to drift lower here, whether that just sets us up for a more volatile spike higher at some point soon.
Yeah, no, definitely. I think that the summer itself is going to be somewhat more volatile. It's not just Fed communication that could spur volatility from here on. It's also the data. If there's anything we've learned in the last couple of months, it's that you can't just turn on a switch and have the economy come back online. There's just a lot of bottlenecks that need to be ironed out. There's data that we're going to get that we don't know. The trajectory for employment it turns out to be a lot slower than what we were anticipating. It's not going to be $1 million jobs per month. So at least till we get through the second quarter and third quarter, I think we're going to see a little bit of volatility in the data. And the Fed is long overdue, I would say, in my opinion, to start thinking about tapering asset purchases and communicating those intentions. And I think that those intentions are going to start getting communicated as early as next week.
On a strategy basis, Subhadra, with where we are, what do CFOs do? Do you look, is the great unspoken here, there's going to be a wall of bond issuance coming out in the next 6 months? I've lost track of, what the corporations are actually going to do. Are they going to pile on more debt?
Yeah, I mean, I think if interest rates are low, that's what you should be doing, right? Borrowing as much as you can, and there's definitely a case to be made, and it's already happened. I mean, a good portion of this year we've seen tremendous amounts of corporate bond issuance. What's really interesting is the amount of demand that's been from end investors for all this issuance that's come into the market. I mean, whether it be investment grade or high yield, I mean, spreads are extraordinarily tight.
Yeah. Well,
so, and this demand continues.
Subhadra, that's where I wanted to go. This idea that high yield bonds are now yielding 1 basis point away from the lowest ever, sub 4%. We're looking at 3.89% on high yield bonds. And the record sales pace has been absolutely blow your socks off. I mean, basically, that's a CFA term, Tom. There is a question about the moral hazard here. The idea of the complacency of a low-rate regime here on out, tied with companies selling bonds to raise money to buy Bitcoin, like the MicroStrategy bond, to raise money to pay dividends, to pay money to the private equity ownership. At what point does this become a problem, or are we in a never-ending cycle of ever lower yields?
So I was listening to Romain earlier on, and he was saying at some point there's going to be a correction. So I'm kind of in that same camp that, things do get a little bit out of hand, and then you're going to see some sort of a correction. And for that to happen, it's going to come from a change in the policy stance. Right now, the Fed's, keeping its asset purchases. At some point when they start tapering asset purchases, these real yields that you're seeing at negative 92 basis points or negative 1% are going to have to move higher. And guess what? When real yields start moving higher in a steady, systematic way because the Fed's trying to remove accommodation, this is going to have an impact on risky assets. So we're not there yet. It's really hard to time this, but definitely that's a risk in the horizon.
Subhadra, thank you so much. Subhadra Rajappa there from Societe Generale on U.S. rates and the derivative heritage of Sakchen there on the dynamics of these rates, and the major dynamic has been shock and awe here. Romain, you've developed a firestorm of comment. David out on Twitter is watching. Thank you, David, for watching and listening, and he's all over a Chewy toy, dog tough, Destructosaurus dino toys.
Yeah, that's for the big dogs there. I don't know. I thought you had the little tiny little. What do you have? Those little toy poodles or something?
Yeah, I had the toy thing. Yeah,
the toy thing.
And
what do you just carry those around Central Park and?
Yeah, exactly. Precisely. Okay. We put them in the overpriced designer dog thing and walk them around.
You got to get one of those little like baby carriages for the dog.
Oh no, they have that. Those are in those. Yes, we're one step away from those. Lisa, I look here at the excitement of internet and retail, and this goes to David Rubenstein with Jonathan Gray, and I adore what Jonathan Gray said in that interview with Blackstone, where he talked about don't invest in buggy whip industries. And to me, it's like the biggest deal, because you talk about Chewy and Chew toys, and it's just an Amazon equivalent, isn't it?
So I'm not going to be giving chew toys to my children. I'm just going to put that on the record. Not that it would ever cross my mind. Going forward, though, what
have another drink and you'll change your mind.
Okay, you can just give me a Tang Mimosa in the break. There is a question, though. What is a buggy and whip? Whip and buggy? Buggy whip. Company. I don't even know what they are. But I mean, honestly, what is that company at a time when technology is changing that quickly?
I would defer to Mr. Gray of Blackstone, but I suggest buggy whip is 3% revenue growth.
Maybe it's coming back.
That's buggy whip. Futures up 7. Stay with us on a Friday. Guy Johnson in Cornwall. This is Bloomberg.
Craft.
Don't steal mine.
With the First Word News, I'm Ritika Gupta. The world's richest governments are under mounting pressure to help poor countries fight climate change. At the G7 summit in the UK, they'll get a new chance to do something about it. G7 leaders, including President Biden and German Chancellor Angela Merkel, are meeting in Cornwall, England through Sunday. On the agenda is a discussion of how to help finance a shift to cleaner energy in low-income countries. And the debate over how to pay for the nation's roads, bridges and transit systems continues on Capitol Hill. Disagreements about whether motorists or corporations should foot the bill are threatening to hamper negotiations between President Biden and Senate Republicans for a massive infrastructure plan. Biden pulled out of one-on-one talks with West Virginia Republican Senate Shelley Moore Capito. And a prominent Harvard Medical School professor has resigned from the US FDA advisory panel. That's over the agency's decision to approve Biogen's Alzheimer's drug Aduhelm. Dr. Aaron Kesselheim is the third person to quit over the clearance, which he called, quote, probably the worst drug approval decision in recent US history. 2 big clinical trials produced conflicting results on whether the drug could slow cognitive decline. The steel industry is booming like never before. As the global economy recovers from the pandemic, the ripple effects are being felt by everyone from home builders to appliance makers. Demand is so frenzied that some U.S. mills have stopped taking orders from customers in recent weeks. Steel prices in the U.S. have tripled over the past 12 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The curtain will rise again.
Broadway's returning. June.
Have you bought tickets?
Is busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Surveillance, good morning worldwide. The pageantry of the G7 meetings, and yes, it's leaders in a photo op, but also something of great interest to Great Britain. This is, of course, the First Lady, Mrs. Biden, on the obligatory school tour here with well-scrubbed children. They look like Francine Lacroix's children
They don't look like mine,
from
I'll
a
tell you that
distance.
right now.
And with Mrs. Biden, the Duchess of Cambridge, Catherine Duchess of Cambridge, and it's real simple here. There is a symbolism here of her taking up duties for the Queen at 95 years old. We'll have much more from the G7 meetings here. Our guy Johnson in Cornwall. Right now we go to David Lord Wilson here on the equity markets, and you've got the momentum.
Well, absolutely, and specifically the valuation of momentum stocks. You know, MSCI goes through.
What's a momentum stock? Give me a name. It's not a meme stock, right?
Basically, we're talking about stocks that rise faster than others.
Apple
basically.
and Amazon.
Yeah, I mean, that's what we think of. But what's happened is, you know, you look at what's been going on this year. Best performing industry group, you know, in developed markets, energy.
Right.
Not exactly expensive when it comes to earnings. Financial stocks, also among the top performers. Again, relatively cheap. So what's happened is MSCI goes through its indexes twice a year and does what they call rebalancing. Right? Yeah. And so what happened this time around is with the MSCI World Momentum Index, which tracks developed markets. So you're talking 23 different markets around the world.
G23.
Yeah, exactly. You know, before the rebalancing, which was done 2 weeks ago, you know, that index was valued at 30 times projected earnings for the next 12 months. So forward price earnings ratio.
So they went to energy stocks, and what's it valued at now?
Around 18.
Okay, now I see this chart on radio, folks. We're just killing it. Anthony from Sparta emailed and says he needs more charts on radio. Go back to the Wilson chart here. And what I see there, David, and you know the fancy math phrase, is stochastic, which means it's pointing. The momentum stocks go down and crater, and then they turn right around and go up. When do you know they turn around?
Well, I mean, that will be something to watch. But, you know, what really is the point here is that the composition of the momentum index is changing. So in other words, the kinds of stocks, you talk about Apple and Amazon, those are the ones we think of in terms of momentum. Now maybe we have to think more in terms of an ExxonMobil or a JP Morgan Chase. That's how things have shifted. And it's not just here, it's internationally, because we're talking about, you know, a worldwide index.
Yeah, so it's funny you mentioned some of those names that have now become momentum names, Dave. But when we talk about this idea of sort of what people are chasing in this market here, I mean, the whole definition of some of these factors has been completely turned on its head now. So what was once value is now growth. What's once growth is now value. And now what was once, I guess, sort of stayed is now momentum here. How does this all somehow go back and sort of, I guess, revert back to the norm? Or is this kind of the new normal going forward, Dave?
Well, that becomes the issue because, like in the last couple of weeks, we have kind of seen a shift away from, you know, the cheaper shares when you look at, you know, energy or financials or whatever. So, you know, that remains to be seen as a theme, you know, because a lot of this, let's face it, has been tied into what's been going on in bond markets with interest rates rising. And we know at the moment, you know, the treasury yield is sort of stabilizing, if nothing else.
Dave, that's exactly where I wanted to go. This idea of the narrative driving the shifts that you're seeing beneath the equity market right now. What's the current prevailing narrative, given the fact that the one coming out of bonds has changed a lot?
Well, and it seems to be changing in stocks, too. I mean, that's the challenge, is kind of picking out where we are now. We should point out with this MSCI index, it tracks price changes over 6 and 12 months. So really, the 6-month time frame is more where you saw, you know, energy and financials and those kinds of shares doing relatively well. So, you know, that's going to be something to watch going forward to see if indeed that carries on or we kind of shift back to where we were before.
David Wilson, thank you so much. On the equity markets here, we're looking again at futures up 5, Dow futures up 60. Romaine Bostic, what's fascinating to me is we partition the big cap, SPX, Dow, et cetera, and we do that over to NASDAQ 100, say, and we forget about Russell 2000, small caps. Are small caps back in vogue?
Well, they were up until a couple of days ago. I think what we've seen before, though, particularly with this drop in yields here, is that this takes a little bit of bloom off the rose of some of those cyclical names, which, of course, a lot of them are in that Russell 2000 here. The only thing really that kept the Russell 2000 afloat really the last couple of weeks was some of those energy names and, of course, some of the biotech names. But those cyclical names right now falling out of favor in favor of, I guess, some of the more growthier or, I guess, more value-oriented big cap names.
You know, and I'm going to fold this into the Jonathan Gray interview with David Rubenstein. I really can't say enough about it. And Lisa Bramowitz, I mean, we're doing the education ballet at the G7 meeting with Dr. Biden and the Duchess here. It's a photo op, and everybody's happy, and they look fine. On radio, we have the First Lady and the Duchess sitting at a table with a bunch of well-scrubbed cherubs, I guess. I believe that's young Lacroix to the left.
Yeah,
Which one of them? Oh, okay.
Yeah, I think they're to the left there is young Lacroix. But Lisa, what's so important here to Jonathan Gray's comments on Buggy Whip Industries, it's about education first. And that's really what's happened to our equity markets.
There is a question, though, right now, when you say buggy whip companies, the industrials, the old school economy was actually outperforming dramatically because of infrastructure plays. And at what point does that reverse if there isn't necessarily some sort of infrastructure plan agreed upon? There's also a question, and this, I think, really underpins this conviction on risk assets right now as bond yields go lower. At what point do we worry about lower earnings profits, about the idea that earnings growth has such high expectations to meet in the second quarter? Can it meet that, given what we're seeing with the bond action?
Lisa, one day at school, did your kids ever look like the kids sitting to the right of Dr. Biden?
I mean, really? Absolutely
Never
not.
Once.
My younger son uses his mask as a crumb catcher. I mean, he puts it under his chin when he's eating, and it's just like they fall in there.
Yeah.
I've never seen anything quite like
At the
this.
G7 meeting, and we continue forward, I believe.
Did you know, Tom,
Yeah.
I just Googled this. Did you know there's still a buggy whip maker out there?
I did not know that.
And it's in Westfield, Massachusetts. It's called Westfield Whip.
Yep.
Yeah,
That's
there
where
you
they
go, Tom.
came from ages ago. They're probably used to, at Devon, the horse shows. They probably still use the buggy whips long ago.
Wait, in all seriousness, what is a company that's going to be obsolete in the future, right? I mean, people were betting that GameStop would be, and now they're going to sell shares and try to Amazonify themselves.
Okay, but I don't mean to interrupt, Lisa, but this is absolutely critical, your observation. The reason they're there is they're kept alive by the absurd rate structure capitalism has given us.
Well, right. The idea of zombification of the market, the fact that companies can borrow money and prolong their existence and then try to justify why they exist later. The question is how they're going to justify it, in a world that's constantly changing. And it really raises this question. I mean, are you a buggy whip company if you've got a website?
And maybe they evolve, though, too. I mean, keep in mind, a lot of buggy whip makers actually went on to become automobile makers and auto parts makers as well. Yeah, quite a few did.
You just captured a G7 moment there. For those of you on Bloomberg Radio, and it really looks like this. Rachel from Indiana emails in. She demands that her son looks like those cherubs every day.
Really?
Yeah, right. Okay, what you just saw there, folks, and this is one of the vignettes that we bring you with Bloomberg Surveillance with team coverage in Cornwall, is the camera was on the well-scrubbed kids and the Duchess and the First Lady, and then the camera spun around to the press crew, which was at the Sloop Inn in St. Ives until 4 in the morning. It looked like they'd been run over by Guy Johnson this morning. We're going to continue. Futures up 5, Dow futures up 64. All is with peace in Cornwall. This is Bloomberg. Stay with us on radio, on television.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Europe's financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacwan. We'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
We, I think, are seeing the face of the new shape of inflation in the post-pandemic world.
Inflation expectations are back. I think the Fed is going to need to recognize this risk.
The Federal Reserve, they take inflation very seriously. They think about the data.
We need to see whether these supply issues are indeed short-term, but if they are going to be persistent, then central banks probably will have to move.
Low inflation, low rates, positive economic growth, and strong earnings, that's a pretty good backdrop for risk-taking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
A new paradigm of ever lower rates. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, Jonathan Ferro, Lisa Abramowitz, John Off, Romaine Bostick, very much in a new paradigm of ever lower rates, a new paradigm perhaps of inflation as well, a new paradigm though also of international relations. Tom, I know I'm just killing you with all of these references to the
paradigmatic shift
but
here.
The
I mean,
G7,
you're killing me on the edge of London School of Economics. So
the G7 meeting very much in the front of center, the paradigm of international negotiations, Tom.
Yeah, it's Friday. Let's have a paradigmatic Friday. The paradigmatic Friday, folks, is all of global Wall Street stands in shock. We're in Cornwall as well. Our Guy Johnson, Josh Wingrove, and Jessica. There is Jennifer mental block here. Help me here, guys.
Jennifer Jacobs.
Jennifer Jacobs. There it is. Jennifer Jacobs. Please come on air and tell us about our demarche this weekend. Jennifer Jacobs there as well. And with it is a Friday in the summer, but seriously, folks, it's the shock and awe of where yields are. Lisa, do we have a why besides short covering?
The idea here that transitory is the way to go, and you can go ahead and drink. But Romaine, I mean, you can see this through stocks as well. People starting to shift their view of inflation from a long-term persistent trend to something more in line with what the Fed is thinking about.
And to tie it to the equity market, we should point out, too, I mean, the bond market has really kind of been nudging in this direction for quite some time. I think it was the equity market that was a little bit less convinced. I think they finally sort of, had their little moment here where they're starting to realize that maybe the bond market has had it right for all along, at least for the past 6 or 7 weeks or so. That's why you're starting to see that rotation into some of those bigger cap names. And that's why you're seeing a little bit of a rotation, unfortunately, out of some of those cyclical names.
The VIX 15.81 says volumes as well. I want to go back to the G7 here. We've got lots of different ways to go in this hour. But Lisa, you know, we're doing the photo op thing. What we've seen in the last couple hours, folks, on radio and television is a conventional G7 meeting. The normality of it, Lisa, is extraordinary when you look at the First Lady, the Duchess of Cambridge, doing the obligatory school visit. We just had on the break, folks, the First Lady and the Duchess of Cornwall with the Duchess of Cambridge, excuse me, with the well-scrubbed.
You're burying the lead. Tom, you're burying the lead.
No, they were.
It was a Beatrice Potter moment.
It was
sitting
yes.
in front of a little garden shack with a bunny and
no,
carrots.
That's not just a bunny. That is Poldark the bunny. Now, come on, you got to get with it, right. Lisa. But what this underscores is that the goal here is to do lovey photo shots and then move on to Mr. Putin, June 16th.
Yeah, the lovey photo shots. And there is a question of who it's geared toward in terms of the consensus in the G7. But it really comes amid a backdrop of a world that is recovering, Tom, and the melt-up is persistent.
I mean, and Romaine, what's so important here quickly is the idea of chummy, which we talked about the last couple of days. I mean, that's really the goal of Mr. Biden.
I think it is important. I mean, we can obviously make fun of some of the images we're getting here, but the relationship that had deteriorated between the U.S. and UK was certainly palpable, and there is sort of a reparations going on right now with regards to sort of repairing that relationship, and a lot of it is just symbolic. A lot of it is the visualization here, and hopefully that translates into actual policies that benefit not only the U.S. but hopefully the UK and the rest
Futures
of
up 6 now, futures up 79, the VIX comes in 15.81 on the yield space. Lisa floored by a 144.51. 10-year yield. Did we expect that 10 days ago?
No, we did not expect that. And the real yield going further and further negative to near the lowest now since February. And the question is why? Where is this conviction coming? And is it just a short squeeze, Tom?
What we're going to do is take the prodigious mathematics of Alicia Levine at BNY Mellon, their chief strategist, and fold it into the arch issue. Tomorrow, you're going to be looking at your barons at the living room table going, what do I do now? Alicia Levine joins us to correlate it together. Alicia, is the math of the market working right now? Because I got too many people saying, this is original, it's different. Is it really?
Yeah, good morning, and thank you for your kind words. Look, it is different. It's very perplexing. You know, from what we understand, there is a positioning issue and there is a short squeeze in the bond market that really started on Friday with the jobs report last week. Having said that, there are things that are very clear, right? What's clear? We're getting inflation. It may be transitory, but on the other side of this, we are probably ending up higher than we did during the post-global financial crisis. So we're getting inflation. Some of those components will not be transitory, as we're seeing, particularly in the rent space, in the housing space, and probably in the wage space as well. So that is something, but the big bump is probably over, and the shock is over in terms of the numbers we're going to see. But there is inflation. That's true.
Is this a bull market where it's a grind higher? Or can you give me some romance, some drama here?
Look, here's the other thing. Now you've got real yields almost -1% again, right? Dropped from 0.6 2 months ago. So your break evens are higher, your real yields are lower, and so that is actually a great recipe for risk assets. And what this means is that the Fed has sold its story. And the Fed has convinced everybody that they're going to roll with it, that they're not going to react to it, and they're simply not moving for a couple of years on the rate side. And that's what this all means. So putting that back in the framework of what do I do now, you buy stocks. That's what you do now. Because a mild inflationary environment is actually great for equities. It's great for businesses. It's great for wages. And you don't have a Fed that's going to come and kill it all. So you got cyclicals going and you'll have tech going here.
It sounds great. It sounds perfect. And there is a question of a Federal Reserve that's under increasing pressure from former Fed officials, among others, saying, you guys are by definition going to be late, and it will be catastrophic because of all of the risk that's building up exactly in this environment, this Goldilocks era that you're describing. What is the potential risk of Fed officials coming out, starting to take some of those criticisms seriously, talking about tapering, and suddenly throwing a wrench in this rally?
Well, that's the issue. Now we're positioned for the other side. Right now we're positioned for the Fed has waited too long, forward guidance has been way too dovish, and they're going to have to overcorrect. I happen to think that's the biggest risk in the market right now, which is that the Fed has successfully, lulled everybody to sleep with the Kool-Aid, that they are never really going to focus on inflation and are only focused on the labor issues, and the labor market is not moving as fast as the inflation expectations are. And so they've lulled us all into thinking they're just going to sit there, and the risk is they don't. And I think the risk in this kind of strategy is that they have to, in a sense, overcorrect, as Selena Myers said famously, on the other end of this, and then you can get something that is worse than if they sort of slowly took back some of the accommodations slowly in their forward guidance. So that's your risk here in the market. We are priced to a bullish economy, a growth economy, mild inflation, and the reintroduction of the business cycle. Remember when we used to grow more than 2%, with a little bit of inflation? That's not so bad. Yeah. Not so bad.
I've forgotten those days, Alicia. Go back to the risk here, because I'm actually surprised at the reaction in the market to the drop in yields. There was a general expectation here that we were preparing ourselves for the roadmap, at least, of what a soft landing would potentially be like here with the Fed. And I feel like there's either a lack of control or an unwillingness to control what's going on in the bond market right now. And I just can't really wrap my head around how this ends well.
Look, I'm scratching my head. I've reached out to our traders the other day, like, help, what the heck is going on? None of this makes sense. And there is risk here that simply the inflation mandate is simply thought of as not mattering anymore in a way. And in a sense, the market's telling you that, because we have the hottest inflation in 13 years and bond market rallied and is continuing to rally. So it means that the Fed has successfully said that their dual mandate and the mandate on unemployment is more important right now. And because we have stickiness in the labor market, they're going to sit for longer. And I think it doesn't end well. I think you wind up with an overcorrection and very fast hikes and a very fast tightening on the other end of this, because I think it's a little bit of hubris to think they can control it. In the end, expectations are what we all have, what the market has. And if they let it go too long by focusing on the labor market, they run that risk that expectations become unmoored.
So are you raising cash right now, Alicia?
I'm not raising cash right now because I think the party's still on. I do. Okay. But that's a huge risk out there, and I think you have to have a diversified portfolio. I am worried about the stock bond negative correlation being over forever. That I'm worried about, because it was an easy for asset allocators last 20 years. That was easy. Yeah. You hedged your risk with bonds, and then you had your negative correlation in off markets. That has not been the case in the last 4 months. The bond market and the equity market have been correlated, and that makes it a lot trickier for asset allocators here.
Alicia,
that's another risk.
We got to leave it there. We're out of time. Alicia Levine, thank you so much. I really appreciate that, and particularly there on the correlations at the present. What an odd week. Futures up 6 and yields coming in with a vengeance. Let's show the romance of a photo op right now. This is Mrs. Biden and the Duchess of Cambridge, and they've moved from this to this. This is incredibly well choreographed. Here's the reality, Lisa. On radio, it is a sterile room with a bunch of people talking about education, no doubt. And Lisa, this is the grind of diplomats, isn't it?
Yeah, well, my heart's bleeding for them. Going from a room with perfectly groomed children who've been instructed how to fold their hands as they take a bunny to an antiseptic room with lots of people in front of microphones. Honestly, again, who is the photo op for? I think that is one of the big questions coming out of the G7.
I think it's well said. I think they're playing to a set of constituencies looking to get through this. We have a program note, please. Romaine, Lisa, and I are all on the same page. Stop sending in the photos of your well-scrubbed offspring. I don't know what else to say.
I love
You're making
it.
us feel bad.
It's okay.
Worldwide, they're sending in photos of their children looking like in Cornwall. Stop it. Stay with us. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. British Prime Minister Boris Johnson will give leaders a beachside welcome today, formally kicking off the G7 summit. The leaders will focus on economic recovery as the summit gets underway in Cornwall as the world's most developed nations discuss ways out of the pandemic. Wealth redistribution and taxation are likely to be on the agenda. China has approved 2 COVID-19 vaccines produced by Sinovac Biotech and Sinopharm for emergency use in children aged 3 to 17. The country's accelerated vaccine drive comes as the U.S. pushes for a new inquiry to determine how COVID emerged, including whether it leaked from a lab in the city of Wuhan. Bloomberg has reported that G7 leaders will call for a new study into the origins. Some pharmaceutical industry executives have been mixing 2 different COVID-19 vaccines to get what they claim is better protection. Small studies in Spain and Germany showed promising results. In the US, the National Institutes of Health is evaluating the method. One drawback, while researchers say the approach appears to cause more side effects. Global oil demand will recover to pre-pandemic levels next year. That forecast from the International Energy Agency, which urged OPEC and its allies to keep markets balanced by tapping their spare production capacity. The IEA predicts that world consumption will surpass 100 million barrels a day in the second half of 2022 as developed economies bring the virus under control. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's such an interesting new world. The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Crypto is a nuanced issue, and it's possible the U.S. gets crypto wrong.
countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We have already exported 350 doses to the rest of the world, and we took the decision 2 weeks ago to donate at least 100 million doses by the end of this year. The most important, in my opinion, is the cooperation and the coordination among the G7 countries in order to be convinced that we need to donate vaccines and to make sure that the vaccines are accessible everywhere.
Charles Michel, the European Council, with a bombshell announcement from this G7 meeting on aiding so many other countries struggling. I really want to do a massive shout out to our Sam Fazili, Dr. Fazili, who's given his perspective on the Great Britain and United States pharmacology that has allowed for this huge success. Romaine Bostic in for John Farrow, Lisa Bramowitz with us as always. And again, the future's up 4, Dow future's up 62, and the market is there. And then there's the G7 as well. Let's just get right to it right now. The market check is there. Equity's up. You know, yield comes in 145 in the 10-year yield. Guy Johnson holding court in Cornwall. They're deep into the day. We've been showing images of Mrs. Biden and the Duchess of Cambridge, of course, a royal family get-together about 1 p.m. New York time, 6 p.m. Guy Johnson time. And Guy, we dash to bilaterals. What's a bilateral?
A one-on-one, Tom. The first one's going to take place a little bit later on between Boris Johnson and Mario Draghi. Now, that will come, Tom, after we've had what they're describing as an EU coordination meeting. So all of the European leaders have been arriving over the last few hours. Mario Draghi, Angela Merkel, Emmanuel Macron. We've also seen Ursula von der Leyen arriving. Charles Michel, who we were talking to a little bit earlier on. They're all huddled in a room right now. They're trying to come up with a policy framework. They're trying to come up with a message that will basically match the weight and power that is delivered by the President of the United States. This, thus far, almost feels like not a G7, Tom, but basically a coming out party in terms of the foreign policy of Joe Biden. This is the first time we've seen him on the foreign stage, and he is definitely dominating. And the Europeans don't want that to happen.
To the literature of international relations, is it a United States of Europe, or is it a united Europe of separate states? Which is it?
Well, I think it's still the latter, Tom, and it is still firmly the latter. But the Europeans feel that they have 3 heavyweights here, which they need to take advantage of the authority that they bring. Mario Draghi, huge authority, huge economic authority, former president of the ECB. He comes from Italy. Angela Merkel, she's been on the stage many, many years. This is her last G7, as we know, but she's been to so many. Emmanuel Macron, a driving force in Europe. The 3 of them coming together, is that enough really to match Joe Biden? And I think those are the sort of scales that we're thinking about at the moment. Then we go from that meeting into this bilateral, Boris Johnson and Mario Draghi. What kind of message is Mario Draghi going to deliver? Brexit's going to be part of that narrative. There's also the vaccine rollout program. The Europeans are very proud of what they've done, but they feel that they haven't fully been recognized for what they have delivered. How do you build back better? Mario Draghi is the economic specialist. How does that actually happen? How does that actually take place? And hopefully that bilateral will deliver some of that.
Guy, a coming out party for Joe Biden. It's also a question of nexus of power. Is he coming as the leader of this group, or coming as a guest trying to regain some sort of leadership role?
Well, it's a really interesting question, Lisa. Theoretically, the leader of this is at the moment. Boris Johnson, he's the host here, but it doesn't feel that way. This definitely feels like it is very much centered around Joe Biden. He's the new force. He's not Donald Trump. Everybody's happy with that. Everybody's much more comfortable with this meeting. All of these leaders will get on in a way that they simply haven't been able to do so over the last few years. But there is a change. There has been a change as a result of what Donald Trump did and the destruction that he delivered in terms of the EU-US relationship. And the Europeans, I feel, don't want to go back to where they were before. They want to have a much more kind of balanced sort of merger of equals, I guess, in financial terms, in terms of the relationship here at the G7. And I think that's what they're trying to deliver, Romain.
Yeah, and it's interesting, too. I mean, we've been playing images, of course, of Jill Biden, the First Lady of the U.S. here, and the Duchess over there in England. I am curious about the optics of this. I mean, anyone looking at this, particularly folks who maybe don't follow politics and don't know all the ins and outs of the U.S.-UK relationship, you would have to come away with a sense here that this is a relationship that is, if not has been repaired, is certainly on its way to being repaired. And I'm wondering how much of that translates, Guy, into actual policy and actual movement forward.
At the moment, not very much, but I think there is the hope that it will become so. I think there is a belief, certainly in Washington, that the UK has a significant role to play in this new policy framework, this new foreign policy framework that the US is putting forward in terms of generating this group of nations that are going to push back against authoritarian regimes. And the UK has taken a much stronger stance than many other European countries in terms of pushing back against China over the last few years, a strong pushback against Russia as well. Certainly post-Salisbury, that has been certainly policy here in the UK. So I think there is a sense that in many ways the UK and the US are actually reasonably well aligned in terms of the direction of travel for foreign policy. So I think there is a hope that the relationship can be rebuilt, and rebuilt in a way that is mutually beneficial to both sides.
Guy Johnson, thank you so much. Greatly appreciate it. Continuing coverage from Cornwall today with a very busy Friday schedule and into the weekend. And then the president continuing his trip in Europe as well. It is important in the 6 o'clock hour here in New York that we always speak to Matthew Miller with obligatory card talk. It's part of his agreement to appear on surveillance. And of course, with Romain Bostic, it is always important to continue the tradition of Friday soccer with Lisa Bramwitz.
I've got more than a whisper.
Oh, wow.
Inflation fears. Futures up 6. The VIX 15.70. Please stay with us. This is Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Good morning, everyone. Bloomberg Surveillance from Cornwall. Our Guy Johnson there with Josh Wingrove and Jennifer Jacobs. The G7 meetings here in New York. We are observing interesting equity markets and the shock of lower yield. The real yield, a negative 0.94. For those keeping score at home, you would go from a negative 0.83, I'll say, with a real plunge yesterday in the inflation-adjusted yield. Lisa, in the currency markets, a resilient dollar.
Yeah, which is sort of interesting given the fact that people think that the Fed is going to remain so easy. Is this because of a resilient dollar, or is this because of perhaps deteriorating expectations around the world as the virus continues to spread?
Romaine Bostic insisted we continue moving forward as we did with the Duchess of Cambridge and the First Lady in search of well-scrubbed children, which means on short notice we bring in this morning Tom Porcelli of RBC Capital Markets, our chief U.S. economist, and we are briefed that the Porcelli children this morning are well-scrubbed. Tom, your wheelhouse and acclaim is what every American's interested in, and that is wage lifting, and with it, wage inflation. Two-part that. Give us the nominal wage study right now, and give us the inflation-adjusted wage study right now.
Yeah, so, obviously wage pressures nominally have been building, and that's been true for the last, at least the last few months. I mean, as I've been sort of fond of saying, if base effects are getting in the way, then there's plenty of other ways of calculating, how we're doing, whether it's from a wage perspective or otherwise. So on a 3-month average basis, as an example, just look at the wage gains that we've seen. I mean, they're sort of, impressive is not an impressive enough word. In some cases, if you're looking at something like average weekly earnings, the 3-month change is the best that we've seen in about 40 or 50 years. Ditto for average hourly earnings. So there's quite a lot of wage pressure. But Tom, one of the things that I've said to you many times over the course of the last year or so is I think we need to keep in mind that if we think about sort of how this recession ended relative to any other recession, wages performed incredibly well. I mean, it was sort of a perverse thing, I think, for a lot of economists to sort of see or understand. But that's the reality. So we came out of this in much better shape. Now, of course, we have to, relative to any other recession. But of course, as you rightly point out, now we have to worry about wage pressures building.
And Romaine, this is critical in the equity world that you live, and that Romaine, the wage worry folds right into margin worry.
Yes. And we've seen a lot of companies already talk about either labor shortages or just really the idea that they have to pay people a lot more than what they would have paid them, I guess, a year or 2 years ago here, Tom. I am curious here, when we talk about what the Fed's reaction function is going to be, particularly in the backdrop with yields dropping now, at a time where more companies, at least anecdotally, are saying they're having trouble hiring people, and the people they are hiring, they're having to offer higher wages, higher benefits here. I don't understand how the Fed can stand still in this environment should that persist.
Yeah. So, excuse me, Romaine. I think it's the right question to ask, and we wrote this yesterday in our daily deck. I think to me there seems to be quite a bit of complacency building in here. And I think that we're seeing it in all corners. So I think you can make the claim that there's a bit of complacency perhaps by the Fed. There's a bit of complacency perhaps by the market. It seems like everyone, particularly the market, is pricing in this perfect transitory soft landing.
Yeah.
I've said many times, the moving parts involved in trying to really nail the inflation call is considerable. And anyone sort of laying claim, with sort of any definitive stance on it's transitory, I think that there's a bit of complacency being built in, particularly in the market. So I mean, look, it's upon us. We're moving through this pretty rapidly at this point. Our sense, as I've said many times, as we have written many times, is that inflation is going to surprise people to the upside. That view remains as true for us today as it did when we were first making that call, sort of late last year, early this year.
Yeah.
But I agree with that, Romain. I think that there's a bit of complacency.
Yeah. So talk a little bit more about, I guess, the soft landing or I guess the attempt at a soft landing. We know it's going to be difficult, and I don't think anyone thought there wasn't going to be a little bit of rockiness here. In addition to what the Fed has to do itself, of course, there's a lot going on in the Treasury building and with what Yellen is having to deal with regards to the cash pile over there. I'm wondering how much that complicates the situation here if the Fed does try to actually move or at least try to return to some sort of normalization over the next year or so.
I think again, a great question, and I think what potentially complicates it is, there's always complications, but there are complications on both sides. There's a complication if the Fed decides to keep a policy too easy for too long. Complication of that, of course, it relates to markets that are more or less untethered. In a very easy backdrop that does not demand very easy policy. We're looking at at least an 8% growth year here in the United States in 21. I think you're probably looking at something close to 5% next year. So there's a lot of growth. And then I think that's going to lend itself to inflation easily remaining north of the Fed's target over that window. And again, as I said, I think there'll be bouts where it's materially north of there. What's the cost of allowing that to happen in a really easy policy setting? Look, it's not necessarily unique. The challenges, there's always these sort of offsets the Fed needs to consider. But I think that this backdrop today, as I've said many, many times on this episode or in this show and others, I think this
You're on other shows?
Tom Porcelli, carry on.
Never. There are a lot of things though that are unique about this backdrop. When you turn an economy off and turn it back on like a light switch, like we did here in the U.S., and then you make sure everyone is really liquid with funds to be able to drive spending, you're going to have a whole different set of challenges to face that are not in the history book. And I think, again, that is one of these underappreciated ideas, particularly from a policy perspective.
Tom Porcelli, how much is financial stability risk building as the Fed remains on hold, given the idea that companies are selling debt at a record pace and given the fact that rates for them are at record lows?
Yeah. Again, a great question. And I think, the way that I think that everyone has a financial conditions index, right? Bloomberg has one. Every bank seems to have a financial conditions index, including all the seemingly all the regional Fed banks too. I think, though, the problem is a lot of them don't really necessarily tell you if conditions are too easy or, the degree to which they are too easy. And I think there's a couple of ways of capturing the essence of that you can't really see in an index. One of the things that I've always liked to do is, look at what, sort of a lower rated credit is what their rate is, what they're bringing to market relative to the risk-free rate. And what that spread is relative to what higher rated credits are paying or are bringing to market in terms of new issues. And those spreads are incredibly tight right now. They're very narrow. Even lower rated credits are not paying a lot here relative to higher rated credits. I think to me, that's a real useful sign of just how easy conditions are. In fact, you could make the argument that maybe they're too easy.
Well, and this is where I was going. I mean, how much is the Fed being held hostage by the potential disruption to markets that have expanded dramatically? Should they start to taper? Should they start to raise rates? There's concern here that in some ways the market is holding the Fed hostage based on the support that the Fed has given it and based on its ability to go into some sort of tizzy that disrupts the economic recovery.
Yeah, I think that you're spot on in that regard. I do think that the Fed their hands are being held a bit by the market. It's not supposed to be that way, right? I mean, I think hopefully everyone appreciates that. I mean, the market is supposed to be taking its cue from the Fed, not the other way around. I think we all sort of appreciate that over recent years. It hasn't quite worked that way. It has actually worked in the opposite way. So, do I think that? So here's what I think people need to ask themselves, and I think hopefully this is the conversation that's happening within the Fed. If you start the process now and go at it in a really slow way, how much disruption do you give to the market? I would say probably not a lot, right? If you start the tapering process more or less now, within the next couple of months or few months, you go about that in a slow fashion. You give us hikes, taking back accommodation. Let's be clear on what's actually happening there. It's not tightening policy, it's removing accommodation. I think they're very big ideas, different ideas. So if you do that in a slow fashion, I think that the market is going to be able to absorb that in a much more easy way. But if you wait, and then all of a sudden this sort of, this ripping backdrop just continues, which again, I think is a relatively high conviction call for us, then all of a sudden you have to rush and remove accommodation much more rapidly, and that can become much more destabilizing. So yeah. I think the Fed should be, and I'm certainly not telling them how to do their job. They obviously know how to do it well. But I think that that's the conversation that they should be having right now. It's, okay, what's the risk reward of going at it in a slow fashion now versus going at it in a really fast fashion later?
Very good. Tom Purcelli, thank you so much, particularly there on wages and the dynamics, the mystery, if you will, into Q3 as well. Neil Dudd of Renaissance Macro has just been dead on, and he just publishes moments ago, Lisa. It makes very clear he's got a linkage of oil and Brent crude into the inflation decline. He thinks that oil shows every indication of ebbing back, and that will help out on the inflation front.
Fascinating, especially because oil prices are at the highest levels that we've seen going back to 2018 and continue to climb. What will cause them to ebb? And this potentially does have to do with Iranian oil, which is coming back online potentially if this deal goes through. We haven't even talked about that, but it has potential.
Brent Bostic, remain. Sam Stovall talks about the energy move. David Wilson talked about it earlier. How unique is the energy move? Wasn't that a move just off the bottom?
Yeah, it was off the bottom, and you certainly had the proverbial base effects there as a lot of economies sort of got back up and running, i.e. China. You saw that reflected in a lot of the industrial metals, and you saw that reflected in the soft commodities here. You're now seeing the forecast come out of the various agencies here start to pull back a little bit and say, as we get deeper into this year and into next year, Tom, that's going to moderate. It's going to go back to normal growth.
Well, we can ask coming up on the Open. Yeah. We're going to be talking with Jim Bianco over there. Bianco Research President. He'll be talking. I'll ask him about oil, just for you, Tom.
They are in Cornwall, and they are, they're having a beverage of their choice on the deck. The European leaders await meetings with President Biden. Good morning.
With the First Word News, I'm Ritika Gupta. British Prime Minister Boris Johnson will give leaders a beachside welcome today, formally kicking off the G7 summit. The leaders will focus on economic recovery as the summit gets underway in Cornwall, as the world's most developed nations discuss ways out of the pandemic. Wealth redistribution and taxation are likely to be on the agenda. As British Prime Minister Boris Johnson plays host at the summit, his government is keeping a close eye on rising COVID-19 infections. British health officials say there are now more than 42,000 cases of the Delta variant in the UK. That's up nearly 30,000 in a week. Johnson has to decide by Monday whether to proceed with the final stage of reopening the economy later this month. And delays from congestion at southern Chinese ports triggered by new COVID-19 outbreaks are rippling through global supply chains. The disruption is causing further pain for global shippers already struggling with interruptions to supply chains from the pandemic and a ship's grounding in the Suez Canal earlier this year. The debate over how to pay for the nation's roads, bridges and transit systems continues on Capitol Hill. Disagreements about whether motorists or corporations should foot the bill are threatening to hamper negotiations between President Biden and Senate Republicans for a massive infrastructure plan. Biden pulled out of one-on-one talks with West Virginia Republican Senate Shelley Moore Capito. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think it's still a pretty good time for real estate, and I'd say it for a couple of reasons. One is the warning signs for real estate are twofold. Too much leverage, too much capital, and we don't really have that in the real estate system today. The other, too many cranes, too much building. And we're actually below historic levels in terms of new supply.
One of my favorite people in philanthropy and in finance, Jonathan Gray, is one of those rare people who puts money where mouth is. He is with Blackstone Group and has done better than good and all that. And he has been actively generous as a young man coming out of Wharton in Pennsylvania. He's just really, really done it right. He's a real model for philanthropy. Part of Bloomberg Wealth, this with David Rubenstein. You know peer-to-peer, the success of that. And now Bloomberg Wealth with David Rubenstein. Look for that coming up here in July. The Jonathan Gray interview is really quite good. That's where we stole the phrase buggy whip from Mr. Gray here in the recent hours of Bloomberg surveillance. Right now, I hate to say this, Romaine, but this is the interview of the day. Yeah. Jonathan Miller with us with Miller Samuel, microanalysis of housing and rental trends. And I got to be honest, Jonathan, you're always the most important interview of the day. Help us get out to the interview of Christmas. What are you going to be talking about in housing and rentals in our major cities? What are we going to be talking about?
Well, we're going to be talking about much tighter rental markets. What we're seeing right now is a big uptick in leasing activity. Leasing activity for the last several months has been extremely elevated as lower price points are drawing tremendous inbound traffic. Originally, the drop in rents just caused musical chairs, people moving around within the cities to get the better deal. Now we're actually seeing a tremendous amount of inbound, which has been missing from the migration story. It's all been about outbound, but now we have the inbound really starting to take shape, and I think it correlates with the vaccine adoption. I describe it as a V-shaped recovery, V for vaccine. I mean, that's really where we're going. Corporate America hasn't called people back yet in mass, and that would be a tremendous boost to rental demand.
Absolutely, and you're already starting to see the streets in New York start to fill back up. You wonder when some of these apartment buildings are going to start to fill back up, Jonathan. We saw a lot of discounts. We saw a lot of perks being offered by landlords over the past year to lure people into their buildings here. When do we start to see some of those landlords have enough power, enough pricing power to roll back to rescind some of those offers?
I still think we're looking at another year or two for concessions to melt away. I think the market is still highly dependent on it, but nowhere near what it was. And we've been seeing concession use decline since January when it was at its peak. One thing that's been the most incredible turnaround in terms of a sentiment indicator for renting is that we've been seeing lease terms, the length of lease that tenants are committing to, expand sharply over the last couple of months, which suggests that there's a perception that rents aren't going to continue their precipitous decline, and we are seeing stability in rents. I think the tenants are actually showing that in their actions right now.
It's what we're seeing with regards to availability and pricing. Is there a marketable difference between what we're seeing in sort of, I guess, the more normal part of the market, meaning, what people like me can afford, and the really higher end of the market that, of course, had been a big driver for real estate prior to the pandemic?
Yeah, so essentially, prior to COVID, in the rental market itself, the high end was weak, and post-COVID lockdown, essentially, we're seeing an inversion of that the upper end of the market is actually much stronger. And in fact, the top 10% of the market, like Manhattan, is the only segment that saw actual rent price growth. Every other sector, the lower you went in price, the larger the decline, largely mirroring what has happened with unemployment has been heavily weighted against lower wage earners, and that's being reflected in the rental market.
John, one final question, the money question. We saw everybody dash to the suburbs. They dashed to rural America. Do they turn around and come back to the cities?
I don't think so. Maybe to a certain degree. We have seen that in the past, like after 9/11, there was a 3-year return. So that's certainly possible. Remote is the ability to remote work is something that hasn't been seen before at this scale, and I think that's still in the mix in terms of how quickly people move. move back.
Jonathan Miller, thank you so much for the update there. And folks, we see it certainly in a new bubbling New York City as well. Romain, I want to frame up equities here in this great bull market. We way underplay a record high in the SPX yesterday. What is your observation of equity strategy? Are they moving more bullish or are they cautious?
I think the cautiousness is still there, but you are seeing people sort of re-embrace, I guess, some of the longer duration type of equities out there. And I guess it makes sense when you start to see yields drift back down below 1.5. And the idea here that even with the Fed that wants to move, probably is in stasis now for quite some time.
Do we see the ballet of extrapolation where we're 4,200 SPX? I'm using Standard & Poor's, folks, for John Farrell. But if we're at 4,200 SPX, do you see people extrapolating out to 4,600 or 4,800?
Not yet. I mean, most strategies, keep in mind, at 4,200, we're already above the price targets for a lot of strategists out there. A lot of them aren't really ready to move. There needs to be another major catalyst here for folks to, I think, to really start revising upward rather than just saying, okay, we can at least hold the current levels.
I mean, you look at the yield continuum. Alicia Levine, I thought, was really quite good on that with BNY Mellon. I mean, Romain, the equity markets have to be, I mean, Ben Laidler wrote this morning at eToro. Equity people have to look at bonds now, right?
Yeah, absolutely. And I mean, look, I mean, the equity market has for a while been taking the cues from the bond market. They haven't necessarily always bought into it, but I think right now there is definitely been a little bit more synchronicity, I think, between the two, and you're seeing that in the correlations.
I mean, I'm going to get the pre-market here on Clover Health.
On Clover,
it's like 15. And, it's churning here as well. What do I do? Is it an entry point on memes this morning?
I don't know, Tom. You might want to stay away from the memes. Yeah, you don't really strike me as a meme type investor. You got to have some fortitude to stick with that. I mean, they call it diamond hands for a reason.
To review this for people like me not in the game, 9 to 22 to 14.
Yeah, that's quite a ride. That's called a roller coaster. You have to have fortitude, Tom. That's not a cash position. That's not,
Do you have
not the old days.
That's
not a 60.
Do you know, seriously, Romain, do you know in the morning what memes will do during the day? Is there like indication of thumb up or thumb down on memes?
If I knew that, Tom, I'd be a lot richer.
Be here.
Yeah, I mean, I would say ta-ta.
Like Pharaoh.
I'd be watching you at home on the couch.
Okay.
Yeah.
Romain Bostic, thank you so much. Greatly appreciated. Folks, this has been an extraordinary week. We need to say thank you to Tori Cochran and all setting up and moving forward our coverage in Cornwall. Guy Johnson will be there through today and tomorrow as well with Josh Wingrove and Jennifer Jacobs, the president moving forward through his historic European trip. Futures up 7, Dow futures up 94. The VIX a bit different from where it was 1 week ago, 15.68 in this great bull market. The 10-year yield, 1.46%. David Weston at 12 noon with the Senator. This is Bloomberg. Good morning.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Futures higher to start the end of week from New York City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Ferro. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
We begin with the big issue, another upside surprise, adding fuel to the inflation debate.
The debate between transitory and persistent.
That's really where the debate is in the market.
It's not a question of whether or not inflation was going to go higher.
Everybody was expecting some of these transitory price moves.
Double-digit increases in airfares and hotel costs.
The airfares, the used car prices, et cetera.
It was all a question of when they were going to actually peak.
Look at sort of contagion into other components.
The biggest risk is if we start to see wage pressures go up sustainably.
There is some inflation here that's going to stick.
That's when I think you would really start to get worried.
We've got, of course, Jackson Hole at the end of the summer.
The Fed's policy outlook.
That is the critical moment.
The debate may be heating up, but if bond markets have their say, there is no risk of runaway inflation. Joining us now, Invesco's Christina Hooper and Jim Bianco of Bianco Research. Christina, I want to start with you. Given that Treasury yields have fallen precipitously, on pace for their biggest weekly decline in a year, are they correct that inflation concerns really are transitory and the Fed is correct?
Well, they think they're correct for right now, and that's all that they know. We don't know whether inflation, this big pickup in inflation, is transitory or more persistent just yet. And so their best guess is to follow the Fed's counsel, which is that they are expecting a surge in inflation, but they're expecting it to be transitory. And so finally, markets are trusting the Fed. And I believe that the Fed really has changed its inflation targeting policy. When it implemented flexible average inflation targeting last summer, I don't think there was a recognition of what a significant paradigm shift it was and is. But now there is a growing recognition of it. So it really doesn't matter if inflation is transitory or persistent. It matters what the Fed thinks about whether inflation is transitory or persistent. And that's what markets are finally getting.
Jim, what's your sense?
I think if we take a step back and we remember that the bond market is bought by bond investors, I know that's a wild thought to think. The first quarter was the worst quarter in history to own bonds. You lost 16% in the 30-year bond. Through Wednesday of this week, you were still tracking the second worst year ever. We started the year under 1%. Now we've gone down to 145 and everybody's screaming there's no inflation. Sounds like a pretty bad year to me to be a bond investor. Sounds pretty consistent with the idea that the market is somewhat worried about inflation, but we've had a decent rally in the last week or 10 days. And we've seen a big narrative shift. If you're bearish, I think this is what you want to see for people to kind of get out of this whole idea that inflation's going up and get solidly into the transitory camp. So what I see is I see a bond market trading on its flows and dynamics, and I don't see a bond market yet reflecting that there's transitory inflation. If it was, we'd be back down at 1%.
So Jim,
if they really thought that there was transitory inflation.
Am I hearing the sense that you're shorting treasuries here?
Yeah, no, you're hearing the sense of a person who's been bearish on treasuries all year. I'm not unhappy with that position because, like I said, it's been the third worst year ever. And I am surprised that we've seen a rally in markets over the last, 10 days or so, but it hasn't done anything to change my opinion about where the economy is. Look, treasury yields do not determine where inflation is. The data does. And one thing that's consistent about the data is it's been not very good. In the last 90 days, we've had 2% inflation, just in the last 90 days. We've got an annualized rate in the last 90 days of 8% inflation, way more than anybody thought. And that's what worries me, is that we're still not appreciating how much inflation is actually in the system.
Christina, is that your view, too, that basically markets are overly sanguine about the inflationary risks and that bonds are poised to sell off once again?
Well, they certainly, yes, I do think that there's some truth to that. But the reality is that markets are just following the Fed's guidance, and that seems to be a good path to follow right now. I don't think that the Fed is going to budge and start raising rates in the next few months. I think that I think the timeline is pretty obvious, that we're going to get an announcement at Jackson Hole that tapering will commence in the fall. And I think it will be rather orderly. And I don't think the Fed will flinch with higher inflation because it's focused on a variety of goals now. It's not just about inflation. It's concerned about employment and reaching full employment and all kinds of things that were less important to the Fed in the past.
As we were saying, U.S. Treasury yields heading for their biggest weekly decline in a year. This prompted TD's Priya Misra to short the 10-year ahead of next week's Fed decision. She writes the following, quote, "The median 2023 dot is likely to move higher, and the Fed can start talking about the conditions and timing of its exit. This should come as a surprise to markets, which are priced for a dovish Fed. Certainly that's what it seems based on the move so far this week." For more, let's bring in Bloomberg's Kaylee Lyons. Kaylee.
Yeah, they certainly are, Lisa. Riddle me this one. We get 5% on headline CPI, the core metric, the highest since 2008. And instead of a sell-off in the bond market, we get a rally with yields moving lower by about 6 basis points after that data yesterday. Again, we're taking higher today. We're up about 2 basis points now, but with the declines we saw on Tuesday and Wednesday combined with yesterday, it all adds up to a drop of about 9 basis points on the week, which is the biggest weekly move to the downside in an entire year, as you said, since all the way back in June of 2020. Now, granted, it looks like a lot of this may due to a bit of a squeeze, shorts unwinding their positions, but it also speaks to a bond market that seems to be buying what the Fed is selling and viewing the inflation spike as transitory. Now, we see that reflected in break-even rates as well, which shows us how the market is gauging price growth on different time horizons. And across the board, those have come down over the last week. The 2-year break-even rate, which of course is the nearest term, has fallen by about 10 basis points, and longer-term inflation expectations have fallen too. We're down about 7 basis points on the 5-year break-even, 6 basis points on the 10-year, and of course, those longer-term break-even rates are much lower than that on the 2-year, which again underscores that whole transitory idea, Lisa.
Kaylee, thank you so much. Christina Hooper and Jim Bianco both still with us. There is a question about the feed-through effect of these lower yields on equity prices, on risk assets, on this flood into more yield. And I'm wondering, Christina, whether this concerns you, this idea that the Goldilocks narrative can only continue for so long. Does the risk that's building on the backs of these low rates present risk or opportunity to continue to pile into that trade?
Well, I certainly think it's having an impact on which part of the stock market is performing well. So we've certainly seen a resurgence in tech performance, relatively speaking, in recent days relative to cyclicals and value. And I think a lot of that has to do with lower rates, making valuations more attractive on tech names, for example. But I think that we've already lived through yields going up this year. And it was okay. The stock market didn't crash. Yes, could we see more volatility? Absolutely. I think we'll definitely see it as we get closer to the Fed making announcements and doing more to lay out its timeline for tapering. But I don't worry about the stock market. I think, this is just a normal part of what happens when an economy recovers. And we do go through some anticipation about what central banks are going to do, and it does impact markets. But we need to look at the long run. This is and also we need to take a step back. This is an economy that is improving. If you had said to me a year ago, this would be the scenario we'd be sitting in right now, I'd be pretty happy. We're seeing a strong recovery with elevated household savings. We have increased confidence. We have so many things going for this economy. So no, I'm not worried.
And I will say that this is a good argument for stocks. I don't know, though, about credit. And Jim, I want you to weigh in. I was looking this morning at junk bond yields, which had fallen to 3.89%. That is 1 basis point tied with the record low, sub 4% junk bond yields. The pace of sales has been off the charts this year. At a time when we may be at peak growth, does this concern you? That people are pricing to perfection the levering up of corporate America?
Well, they're pricing to perfection a lot of things as well, too. Not only in the junk bond market, but in the investment grade market as well, too. Those are very close to all-time lows, not quite there, but very close. And the stock market's valuations are some of the highest that we've ever seen, being justified by huge earnings as well, too. But I think when you step back and you look at it, yeah, it is a little bit worrisome because anything that could come along and upset this, growth disappoints, interest rates go up, some kind of unforeseen event, this market is not, or all these markets, especially high yield, are not ready for it. Now, the one thing the high yield market has going for it and the IG market has going for it is the perception that there's a Fed backstop. You are co-investing with the Fed. They're not there now. But the perception is that if those markets ever got a little sloppy, they would come right back and start buying those markets en masse and cushion you. So that is also reducing a lot of the risk premium in there.
Jim Bianco, Christina Hooper, thank you both. You are both sticking with us. Bloomberg's Abigail Doolittle joining us now with a look at the stocks moving ahead of the opening bell. Abigail.
Lisa, we're looking at modest gains for the futures right now, and the meme merry-go-round, it continues. And what's old is new again. We have both AMC and GameStop popping this after some declines recently for both of those companies, those stocks, after both companies over the last 2 weeks announced that they will be issuing more shares, taking advantage of the huge rally. And we have a new name, Amesite, an AI company, up as much as 90% in the pre-market. Interestingly, there's not a huge short interest there, telling you that these Reddit traders, that this move for these penny stocks, originally penny stocks, again, AMC and GameStop about a year ago, $2, $4 stocks, Amesite, the newest target, but again, not with the short interest. We have a bit of a reflationary tone. Yields are up just slightly, but the metal space, we have nice gains here. This, of course, in sympathy with copper. Copper up about 2% on the day, so you can see lots of the metal and miners, those stocks are higher in the morning, setting a slightly risk-on tone, Lisa.
Thank you so much, Abigail Doolittle. Coming up, the G7 summit officially kicking off. We'll be live from Cornwall, England to see what's on the agenda. That conversation coming up next. This is Bloomberg. and better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We have a clear vision in Europe what we want with China. First, we don't paper over the human rights. Second, we think we need to engage with China on some global topics, COVID-19. Three, we want to rebalance the economic relationships. We don't want to be naive, and we think that this cooperation and the very strong ties between the United States, Europe, and the other like-minded partners is key in order to have more influence and to try to push China in a more positive behavior.
EU Council President Charles Michel putting the spotlight on geopolitical tensions. This with China's top diplomat urging the U.S. to restore normal ties with the country on a call with Secretary of State Antony Blinken. The G7 summit kicking off. Bloomberg's Guy Johnson joining us now from Cornwall. Guy, what's the latest?
Lisa, we're about to see the formal arrivals. So I think the president is just pulling up on the beach. There's going to be a family photo where they all get together. I think the president is going to be standing next to Justin Trudeau and Boris Johnson in that photo. So you'll start to see that unfolding over the next few minutes. Hopefully we'll get some pictures of that. The formal plenary session will start at around 45 minutes past the hour. There'll be an introduction by Boris Johnson, and then we'll get into the first real subject of this summit, and that is going to be building back better. They're going to focus initially on the economy, how to get the economies up and running again. There's Boris Johnson and his wife heading for that family photo and those introductions. And what we're going to be then seeing is a focus on building back the economy better, a focus on developing poorer nations and making that much more sustainable, Lisa.
This looks like an advertisement for vacations in the Bahamas. I will say, Guy, there is a question of what is supposed to get done today. There is discussion about economic development post-pandemic. What are we hearing in terms of global minimum tax rates or in terms of redirecting International Monetary Fund funding to poorer countries?
So let's pick up on the second part first. There is clearly a desire to pick up the pace on this. The pandemic has basically meant that there is a greater need for funding, particularly for sustainable funding for some of these poorer nations. There was a commitment made a few years ago. That commitment has not been made. That commitment has not been met in terms of funding the development of poorer nations, and the pandemic has only made that worse. So the commitment now needs to be even greater. So hopefully we should hear something about that. In terms of when it comes to what is happening with the vaccination process, we should start to be able to put some numbers on that. But again, all of this is really critical in terms of the detail that we're going to get. At the moment, this feels like very sort of high-level stuff, particularly on the financing. Whether or not we actually get sustainable details that are actually going to be delivered upon, Lisa, remains to be seen. You can see the arrivals now starting to get underway. That looks remarkably like Ursula von der Leyen.
Yes, it's a beautiful setting also, we should note, and very nice that you can be there. Guy Johnson, thank you so much for that update. Christina Hooper and Jim Bianco is still with us, and there's a question of all the political uncertainty, the political speak, and whether it actually matters. Jim Bianco, does it matter to anyone in the market what comes out of the G7?
I think there's only, from an economic standpoint, one thing that matters. How are we going to do global vaccination? That is the thing that we need to kind of get the entire global economy back on track. The Biden administration announced 500 million doses for the rest of the world that they're going to purchase and distribute. That's a good start, but they have to continue to move forward with that. As long as we have big COVID cases outside of the developed world where we have high vaccination rates, we're going to have a hard time getting everything really back on track.
So if there is a high vaccination rate, how does that change your investment thesis, Jim?
At that point, I think you could probably see the emerging markets and a lot of other markets, which I know have been performing fairly well, start to realize the potential that everybody is pricing in for them right now. They're rallying on the hope that we're going to get that high vaccination rate, that we're going to see far corners of the world starting to return to normal. And if it doesn't happen, it can be a disappointment. So the idea is we're buying the rumor that we're going to get everybody back to normal, and we got to hopefully get everybody back to normal. Otherwise, it's going to be sell the fact that it didn't happen.
We're watching images of leaders from around the world walking on the Cornwall beach for a family photo opportunity. Christina Hooper, I pose this to you. Aside from the vaccination and the pace around the world that we see of moving beyond the pandemic, there is a question about policy and how it affects investment. And I'm thinking of taxes in particular. How much are you paying attention to the potential implementation of the global minimum tax rate?
Well, of course we want to follow it, especially since it's a cause for concern among some investors, right? They're asking questions. They're worried about what the impact might be to their investment portfolio. But the reality is we are a very long way from anything like that actually happening. Certainly, the G7 was quite surprising and certainly viewed as a positive development that they were all able to come together and agree to a minimum global corporate tax. But the reality is that after they formally approve it at the G7 meeting, there are many other steps, and it's non-binding. So I'm not too concerned about it, but certainly we want to be well-versed and follow it closely just because it matters to our clients.
We're looking right now at images of Mario Draghi of Italy joining Boris Johnson of the United Kingdom and his wife for a photo op on the shores there of Cornwall on the G7 summit. And Christina, I want to pick up on what you're saying, which is this policy, there are a lot of additional steps that have to be made before those taxes go into effect. Perhaps the direction is a little bit clearer in the United States, where their policy is likely to be passed for some sort of infrastructure spending. Jim, how much are you paying attention to that and the prospective tax rates that people say are not exactly priced into markets yet?
Well, in the U.S., I think that, you're right, that there isn't a big pricing in of the potential of a 43% capital gains tax or any other type of tax increases as well, too. Largely because I think in the U.S. we have a 50-50 Senate, and the belief is that that's never going to make it over the finish line. So it does potentially have a surprise for everybody. I'll agree it's probably not going to happen in the form that we think it, or the form that it's been proposed. But there is definitely a risk that if a Joe Manchin or Kyrsten Sinema did change their opinion and you'll go along with it, that we can see taxes kind of surprise everybody in the U.S. and be higher and faster than we thought.
What do you think, Christina? Is this something that you're paying attention to in terms of rejiggering your equity expectations, with some people expecting a correction? I'm thinking Morgan Stanley's Mike Wilson among those, expecting a correction on a tax rate of 25%.
I actually think a tax hike is unlikely at this point. Of course, we want to follow it closely. It would be included in a list of potential risks to our outlook, but the reality is that I think it would be very difficult to get something like that accomplished. So we'll want to wait and see and follow it closely.
All right. Well, Christina Hooper and Jim Bianco, hold tight for 1 second. We are watching images of global leaders, prime ministers and presidents and the heads of state from around the world gather on the shores of Cornwall ahead of the G7 confab and the initial day of it. Guy Johnson back with us. Guy, what are we watching? Why is it important? Lay out the day ahead for us.
Well, I think what is important here is just to get a read on the body language of all of these different leaders. I think thus far this event has been largely convivial, but I think behind the scenes there are going to be some difficult discussions. You see Angela Merkel arriving now. I think she probably is going to be at the center of what I think is going to be an incredibly lively debate between Europe and the United States. Europe wants to have its voice heard. Europe believes that its policies have actually been the right ones over the last few years. It wants to be dictating policy. It wants to be setting the agenda. Angela Merkel's last meeting, we've got Macron here, we've got Draghi here. I think they really want to get out in front of the debate, and they want to be setting the agenda. So just getting a sense of the body language between all of these people, I think, is going to be hugely fascinating.
So far,
and
what's
watching
the
as they're all
read-through?
sort of standing on the same stage, how united are they?
Yeah, and that's exactly what I was going to ask you, Guy. How united have they seemed? I mean, is there a sense of camaraderie that has been missing from G7, G20 meetings over the past couple of years?
Well, so definitely. Definitely. The last G7 meeting was highly acrimonious, and the relationship with Angela Merkel and the President of the United States, then Donald Trump, really difficult. Those images of Angela Merkel with her kind of arms folded, kind of leaning forward, trying to kind of talk to Donald Trump. That's not going to be there, but the trust isn't back. It's not. Donald Trump has changed everything forever, I think. The trust between Europe and the United States, it's back and it's better, but it's not perfect, and it's certainly not what it was before. The trust from the Europeans to the United States, and that's going to take a long time to come back, and I think that's going to be worth paying attention to for markets, because I think you're going to see some of the economic sanctions being removed. I think you are going to see Joe Biden wanting to build this collection of democracies. What does that mean from an economic point of view? Can we put to bed the idea that it is going to be any more kind of distrust economically across the Atlantic? I think that's something that we're going to watch out for. How this process unfolds, how this relationship is rebuilt, will have economic consequences and will have market implications further down the road.
Guy Johnson, stay tight. Thank you so much for all of the reporting. Right now, we're looking at Boris Johnson and his wife, Joe and Jill Biden, standing next to him, the United Kingdom and U.S. leaders. There, we have seen Mario Draghi. We have seen the Japanese Prime Minister, Suga. We've seen a number of leaders, Angela Merkel also arriving, and Justin Trudeau now coming down the gangplank. There is a question here about the market response, and actually, as the G7 has gone on, the euro has actually weakened versus the dollar, with the dollar strengthening, and perhaps there is some implication, although it's unclear what the policy would be. Jim Bianco, is there a currency policy or anything of that nature that could stem from these meetings, or is the move that we're seeing in foreign currency driven entirely by monetary policy?
Oh, I think right now currencies are being driven by monetary policy and the perception of monetary policy. There's nothing that I'm aware of that they're going to talk about that, unless it comes out of left field, that it's going to be any kind of a significant move for currencies. They're going to talk about politics. They're going to talk about global warming. They're going to talk about the relationship with China. None of this should